check.
Requesting all to please take your seats. We will be starting the event in few minutes. Requesting all to please take your seats. We will be starting the event in a few minutes. Requesting everyone to please take your seats. Requesting everyone to please take your seats. We will be starting the event in a few minutes.
Hello. Good evening, everyone. Request all of you to please settle down. We're ready to start the proceedings of the evening. Vaibhav, you can start. Starting. Sunil, you can start. Good evening, ladies and gentlemen. I'm Ashish Shankar. I'm the MD and CEO for Motilal Oswal Private Wealth. It's indeed my privilege to welcome all of you to the release of the 30th Motilal Oswal Wealth Creation Study, authored by none other than Mr. Raamdeo Agrawal. This evening carries immense significance as this is the completion of 3 decades of a research tradition that really reflects Mr. Agrawal's commitment to knowledge as well as investor education. I mean, he's one of the rare few people in the market who shares his knowledge very, very openly and freely. And for the last 13 years, I have had the opportunity to watch him create these studies up close. The process is always the same. I mean, he literally goes into hibernation. There's a table overflowing with company annual reports, valuation models, handwritten notes, and there's always a book, at the center of every wealth creation study. And not just him, I mean, his partners in the wealth creation study, Srinath and Dhruv, they immerse themselves so deeply into the study that it takes a life of its own. I mean, many a times, when the study starts, when we bump into him in the building, we tend to ask him, what's this year's study about? Because all of us are so curious to, know what he's working upon. But eventually, over the course of the 2 months that he immerses himself into the study, it takes a life of its own, and then a new theme emerges. And this he's been doing with energy, curiosity for the last, 30 years. I mean, this consistency is what has left a lasting impression on all the people in capital markets. This year's theme is very special because it feels like a culmination of 3 decades of research and work. I mean, he was the first person to coin the term, the trillion-dollar opportunity. I mean, for those of you who've been coming regularly or following his wealth creation studies, will remember that in 2007-8, when India hit $1 trillion GDP, he was the first person to coin this term called next trillion-dollar opportunity, which also culminated into a very successful investment strategy that we launched, the anti-top portfolio. This year's theme is called India, the multi-trillion-dollar opportunity, compounding economy and compounding stocks. It highlights the scale and pace of India's transformation, the structural reforms, the rising domestic participation. I mean, this is something he's passionately spoken about. I mean, this entire change from 35 million demat accounts to 200 million demat accounts, right? He's been very passionately speaking about this. The transformation of rising, domestic investor interest, the manufacturing momentum, innovation, the digital infrastructure that is being built, and all of this is converging into a fantastic runway for long-term growth. This study captures this shift with data, insights, frameworks, which will help investors how to participate in this journey, right? We've had a phenomenal journey over the last 17 years where we've gone from 1 trillion to 4 trillion. And we are right now setting ourselves for a similar journey where we'll go from maybe 4 to 16 or 18 trillion dollars, right? So this study actually will help you decide how to participate in this compounding journey. As always, the report comes in 2 parts, right? There is a statistical part which, lists out all the companies which have been the fastest, most consistent, or the biggest wealth creators in the last 5 years. This is a 5-year study, and this sets the tone for the next decade of opportunity that lies before us. This being the landmark wealth creation study, the 30th, we have a very, very special unveiling for you. So let's take a look at this AV that has been made, and I'm sure this will set the tone for the evening. So can we have the AV, please?
(1995) saw the dawn of a new India, and stock market was at its center. Everyone had just one question: how to create wealth in the market? Plenty of answers sprung up. But only one man won public confidence: Mr. Raamdeo Agrawal. He researched wealth creators, decoded it all, strategy by strategy, and gave to us the Motilal Oswal Wealth Creation Study. A study that revealed the sacred truth: long-term wealth needs long-term focus. Year after year, company after company, the results only confirm what he already told us. Real wealth creation needs only four things: quality, growth, longevity, and price. It's never about timing the market, but time in the market. India evolved. Values migrated. We moved from factories to fintech, steel to software, markets to metaverse. But fundamentals remain unchanged. 3 decades, 1,000 plus companies researched, 30 wealth creation studies, every study a tribute to India's wealth creators. After glorious 30 years, the next 30 years continue to hold infinite possibilities, because wealth creation only compounds. Presenting the Motilal Oswal 30th Wealth Creation Study by Raamdeo Agrawal.
This was fantastic. The 30th study truly deserves this special treatment. Like all of you, I'm also waiting to get my hands on the copy of the wealth creation study this year. It's now my honor to invite the person who has shaped this 30-year legacy of research and investor education, a pioneer of equity research in India, chairman and co-founder of Motilal Oswal Financial Services, and a guiding force for all of us here at Motilal Oswal, as well as for countless investors out there, Mr. Raamdeo Agrawal. And in the meanwhile, let me also call upon the co-author of the wealth creation studies, who works very, very closely with Raamdeo ji with full dedication in research and writing, Mr. Srinath Mithantaya. Srinath? So I just want Mr. Raamdeo ji to felicitate Srinath for the years of work and dedication that he's put in to create the wealth creation studies. Yeah. Raamdeo ji, before you present to us the wealth creation study, it'll be great if you can just share some, anecdotes, thoughts of your 30-year journey, with all of us, and then, we can dig into the presentation. Thank you.
Okay. Hello. Good evening, friends. It's a pleasure to be standing again in front of you. 30th Wealth Creation Study. I think it's 30 years, and this time I thought I'll invite Motilal ji to also be here. Typically, so all the HODs, CEOs of the company, they're also here. because I made sure that this one definitely they must not miss it. So the study started off in 97, 96 as a, we wanted to host an event where we wanted to actually celebrate first year of corporatization of Motilal Oswal. Because Motilal Oswal till 95 was a partnership, actually not even partnership, proprietorship company. And then it became a straight corporate as per the new law. And then we said, first year of the company, let's celebrate with some kind of an event. And this is the event we thought. That's how this event was designed. By that time, I had met Buffett in 94, and hence the inspiration came from Mr. Buffett also. And then we started doing wealth creation study. And this studies were inspired by Phil Fisher, Common Stock, Uncommon Profits, and all the writings which came up from Mr. Buffett. So that was a big inspiration. But eventually we realized that this is the best way to learn and enhance the knowledge of your own about the stock market, investing, and what all has happened. Because there is so much of data, so much has happened in the markets, we are not aware of it. Even this time also, when you look at data, particularly you'll see long series data starting from 1950 for the world, for the US, for India, for the sectors, for the companies. I think there will be so many, and I love data. So stock market is nothing but data, and I think a lot of stories go on, but finally the data works. So this is the study of past data rather, not so much about the future, but past only shows us the future. So with that only, we reinforced ourselves. I think Srinath started writing from 2005, 6 or something like that. Then it got deepened even more. Dhruv Mehta has always been with me. I mean, he walks with me from 92 onwards, but I think he started joining the wealth creation study maybe 97, 98 after 2-3 studies, and he realized that it could be worthwhile for him also to spend some time. So that's how he started coming, and now he's more dedicated. He's an AI expert for us. Anything you say, and he will go to the AI and get some more stuff. So that's how he's our tech expert. And so we three of us, we spend most of the time. This year, Vishal Katkoria also contributed. So now the team is becoming a little bigger, and I'm enjoying this wealth creation study even more. So now coming back to this year's wealth creation study, so I read a book called The New Wealthy World. So I was trying to figure out, there was a lot of money being made in the stock market, particularly in India. In last 5 years, we have gone up from about 145 lakh crores of market cap to 450, 460 lakh crore market cap. So literally 300 lakh crores, which is almost like one time of GDP, has been created. So what is the impact of this in the real economy? There is some impact going to be. Now what is the impact? So I wanted to study that. I said, what happens of the wealth effect? What is economists, they call it wealth effect. So is there any book on the wealth effect? So I was searching in Google, and here comes out with this Wealthy World, written in 2001 by Mr. Edmonds of Boston, Babson College, Boston. He's a financial prof, and I found this book to be completely fantastic in the sense that, what he could see in 2000 or 2001, I think I have not come across any book which had that much foresight. In fact, I was joking with some friends, I must recommend, if I can, for a Nobel Prize for this particular guy for economics. So I think he has done he has really opened. So we'll talk about it a little more, but that was the inspiration. So one of the things is, if you read Thomas Piketty book, Capital, and this book, then comes out is that what is the wealth? The very form of wealth has changed over a period of time. Way back 300-400 years back, it was land, it was palaces, it was the estate or some cattle or gold, silver, then it became gold, silver, and then rare commodities and all, and then bank balance, real estate, and then finally market cap. I mean, today, if you go and ask Elon Musk, Warren Buffett, or Bill Gates, how many acres of land they have, how many palaces they have, there is nothing. What they have? Only market cap. They have share certificates of their company. So that's how the whole wealth from physical to paper, and now it is becoming digital, completely digital. So this particular shift over last 200-300 years has happened, and it has accelerated even more so in last 50 years. And fortunately, India is right at the cusp of it, and we all are beneficiary of it. We'll talk about it. This is the story of this year's wealth creation study. So the study is in two parts, wealth creation findings and then the theme. So what is the concept of wealth creation? What is the concept of wealth creation? Process by which a company enhances market value of capital entrusted to it by its shareholders. So this is the biggest magical machine. This we are writing, these two lines we are writing for last 30 years. Little I knew that this year's studies, the heart is the securitization, which is capitalization of the companies. So this is the concept of wealth creation. Net wealth created is market cap over the study period 2020-2025, adjusted for corporate actions and dilutions. And the study this time covers the top 500 companies of 2020. So the cutoff of everything, because these are the significant companies, there is no point in including in the largest and fastest, very small companies. So we have started with the 500 companies. The amount of wealth created is about 148 lakh crores in this particular period. This is by far the largest. It has been growing. In 2001 to 6, it was just about 14 lakh crores. Now it is 148 lakh crores. And as we go forward, this number will keep growing. Then the pace of wealth creation by the top 100 companies is about 38%, whereas the index has done about 21%. This 38% means it has started from the COVID lows in 2020. In COVID lows, the markets were depressed, and that's why the percentage gain is much higher. Otherwise, it used to be about 20-25%. The largest wealth creator, the biggest wealth creator is Bharti Airtel, about 8 lakh crores. ICICI Bank, SBI, Bajaj Finance. So they have all created upwards of 5-6 lakh crores. Just to give you a significance, what really happens, in 2001, total market cap of India was 7.5 lakh crores. 2001, all the entire market was 7.5 lakh crores. Today, one company in last 5 years has created 8 lakh crores. That's a change in 25 years. And this is a change, I mean, if you just do this, in next 25 years, what is going to happen? That's what is the exciting part of it. I'm just giving the context, what it was in 2000 and what it is right now. So the size of wealth created by top 10 is about 46 lakh crores and top 100 is about 148 lakh crores. The crazy thing is, this time, Reliance, HDFC Bank, TCS and Infosys, all four are missing. Because this year, the pace of wealth creation is 22.5% compounded. So any company which has not matched up 22.5%, we have excluded from the study. So this particular study is, I mean, we have been doing this every year, but this year, these four biggies, they have not made it. So just these are the times, other companies are growing so much faster, the big ones are finding it very tough. Another thing is that top 10 companies, the share, because of this four are gone, the top 10 large caps have contributed only 31%. Earlier it used to be upwards of 40, 45, 50%. This is also telling something about what is the march of mid cap and large cap in the total wealth creation. So clearly the large cap has left behind for some time. My sense is this is going to catch up. This churn always keeps happening. This is going to happen in next 5-6 years. They will get their due share about 40-45% of wealth creation from here. The fastest company is BSE at 124% compounded, and this has been quite staggering. Even the profit growth has been 65%. The stock was available at 12p and now it is 53p. This has been stunning right in front of us what has happened. Rail Vikas Nigam, Jindal Stainless Steel, this time for a change, these fastest growth companies are very credible companies. All of them, they are very good. And if you had all the companies in your portfolio, it would have given you 88% compound, literally doubling every year in your portfolio. Most consistent wealth creating companies, there are only 13 companies which have been able to create every year, out of 5 years, every year. And Hindustan Aeronautics comes out right at the top at about 75% compounded. Then all-round wealth creators are there. Again, there are two defense companies which have done so well because they were completely neglected in 2020. And that's why they have done very well. Wealth creation, there's a lot of upheaval about which are the businesses which have done well. Like banking and finance is standing rock solid at 24%. And earlier also it was 22.3%. So clearly, this is one segment where you have to be very careful. This will always create wealth. In fact, my sense is it is going to be bigger in next 15, 20 years. We'll talk about it. And banking, finance, insurance. Now insurance is going to emerge very large and a secular compounder. And then capital market, which is literally negligent in this particular era. The next round, you know, today AMC, ICICI AMC has come out, Grow came up, NSE is yet to come. So there are 5, 6, 7 companies which are already more than 1 lakh crore worth. Even BSE has become more than 1 lakh. So this is a new segment. Capital market is coming up. Take notice of it. It's an asset light, fast growing business. We'll talk about it a little more. Then you have see, like real estate has come back with 1.6%, which was negligent earlier. Autos, they have come back at about 7.5%. My sense is here again, as the discretionary spend builds up, you are going to see a lot more action in auto. I think this chart is very illustrative. What happens, what is the benefit of seeing the data earlier? 3 years back, there was 0 PSUs which were in the wealth creating list. 0 amount of wealth was created, and we wrote at that point of time, probably turning point is coming. And the stocks were very cheap. Now, 25 companies and 25% of total wealth created in last 5 years has come from PSUs. I am not a big admirer of PSUs, and that's why probably I have missed it completely, but this has created. And still, if you look at the PAT CAGR of last 5 years, PSUs are 34% and private sector is 26%. The P multiple of PSUs even today is only 10, whereas the private sector is about 30. So still there's a lot of steam left in the years ahead. Valuations have become, over a period of time, they have become very flattened in the sense that earlier it used to be, if you buy very cheap, it used to do very well. But it is no more so. It's all about across the board. If you bought expensive, you bought reasonable, more or less everywhere the realization is about 35 to 40%. Only if you are able to anticipate the PEG less than 1 or turnaround company, then you have been able to make it about 40-45%. This one, wealth destruction. There is no wealth destruction. Again, this is a zero number, like PSU. In last study, we found that there are some very small of wealth destruction, about 4.5 lakh crores. So 148 lakh crores of wealth creation and 66,000 crores of wealth destruction. It's crazy. I mean, to have literally no wealth means I can't find anybody who would have lost money. If it is not speculated in this market, you can't find anybody, even if he's a useless fellow, he would have made money. So, I think there are, how many companies? I think there are 1 or 2 companies which have lost 66,000 crores in a situation where market cap itself is about 416 lakh crores. So, there is absolutely no loss. So, I mean, this is also a very unreal situation. My sense is, despite wealth creation will be much bigger, there will be amount of losses coming on, and you are seeing some of the crazy listing in digital site, and suddenly they list at 70,000 crores, come down to 20,000 crores. So those things will happen. So as the game becomes bigger, there will be losses. This is very unnatural. So we have to be very careful. We should not believe that there cannot be any loss in investing. Now coming to the theme, India, the multi-trillion-dollar opportunity, compounding economy, compounded stocks. So what is the summary of this book? The book has 4 or 5 takeaways. Almost every paragraph is insightful, but we have taken out few paragraphs out of this. The world is getting wealthier by the day. We'll prove it by the data. How much world is becoming wealthier. India is also becoming wealthier. Second, the most important thing is this. There is no limit to how much financial wealth can get created. In fact, in our mind, there was some kind of ceiling, GDP itna hai, to usse zyada kitna बढ़ सकता hai. You know, those kind of things were there. Here, this book, if you read properly, it clearly opens your mind that wealth creation in financial markets can be literally infinite. I mean, of course, there'll be some kind of a calibration about it, that he has gone about saying almost 5 times of GDP, but GDP itself is accelerated because of the wealth creation. So fundamentally speaking, it can, this virtuous circle of wealth creation, wealth effect, GDP taking it to larger wealth, we'll talk about it. So there can be really, literally you can call it unlimited wealth creation. So you have to imagine that don't worry how big is the company and how big can it become. Look at it today. NVIDIA is $5 trillion and people are buying left, right and center. Google is $4 trillion and Mr. Buffett has bought it $4 trillion Google. Obviously he's expecting multiplicity, at least 3-4 times of that. So one is looking at $10-15 trillion single company coming up in next 5-7 years. Financial wealth can expand at a pace that real output can never match. Financial wealth in the economy can grow at significantly higher pace. We'll give you some data. Securitization, which is the capitalization of the companies, has become the most powerful engine of wealth creation in today's world economy. So he was asking, what is the source of wealth creation in US? So he said, America has become rich because of securitization. They took on to the securitization seriously very early, maybe for 19th century, 20th century, and that's why they became very rich. Rapid rise in financial wealth can lift millions of people from poverty faster than income can. In fact, he's saying that at some point of time, in 2050, today financial wealth, at the turn of the century, it was about 153 trillion. By 2020, it is about, by today, it is about 600 trillion already. And by 2050, he's anticipating, he wrote in 2002 that it could be closer to 4,000 to 5,000 trillion of the wealth for the world. So the whole world become very wealthy. That's the theme, the wealthy world. He's talking about, he's visualizing wealthy world. But this is not just a fiction. He wrote in 2000. We have 25 years of performance of the world economy and world wealth creation with all the difficulties. So my sense is he's mathematically not perfect. I mean, obviously, we can't get next year's earnings right. This guy is talking about 50 years of wealth creation. So I think he's directionally absolutely bang on, but 4-5 years behind the schedule. So I think it is a very interesting book. It is out of print. Probably you try to get it. Digital copies are available. Read these books, but read it peacefully. The world is getting wealthier by the day. Look at it. In 2005, total market cap of the world was about 41 trillion. Now it is 147 trillion at the rate of 7% dollar for last 20 years. This is the history of the world in terms of global market cap. The world was about, so world was about $1 trillion in terms of market cap, GDP. GDP was about $1 trillion and market cap to GDP was 0.2. So world GDP was $1 trillion in 1950 and market cap was only 200 million. Just think about it, 200 million. Much smaller than even Bharti today. And then it has started building up and today $117 trillion of GDP and hold your breath, it's about $141 trillion of market cap and climbing. From 0.2, it has gone to 1.3. What is the US experience? This is the leader, he's the dada of everything. So in 1950, US has maybe $200-300 billion of market GDP and 0.3 means 100 billion might be the total market cap. From there to 2.1 and the GDP is 30 trillion now and market cap is 71 trillion and counting. So this is the evolution of financial markets in US. What is India experience? Look at India. In 2005, India was about half time GDP and market cap was about 17 trillion lakhs. So 17 trillion lakhs in rupees. And from there we have become 416 lakh crores in terms of market cap. Now our market cap is about 416 lakh crores and it is about 1.3 times of GDP. My GDP is about 340 lakh crores. So now this is a summary of world, US and India. Look at only 20-year number. 20-year world market cap has grown at about 7%, whereas GDP has grown at 5%. US again 7% and 4%. India, hold your breath, for 20 years, 14% market cap growth. This is in dollar terms. And GDP about 9% in dollar. These are all dollar numbers and removed from Bloomberg. So this 14% is quite crazy. I mean, if it can continue at this pace, I think it will be seriously a lot of wealth. So market cap growth faster than GDP growth across geographies, across the time horizon. All the three geographies and all the point of time, 20-year, 15-year, 10-year, 5 years. Every time it is higher. So this has led India to from 7th position in 2007 to 4th position in 2024. Now clearly Japan is just about $1 trillion ahead. One good market and we could be kind of reaching them. Even Japan is doing well. But look at China. US of course is untouchable, way out. But China is just about 10 trillion. If we play our cards well, we could be as wealthy financially as them very quickly. They might be at about 11, 12 right now. This is 24 number. They have done well, about maybe 12, 13 trillion. So, but then there's a good chance to become as wealthy as China if we put our policies in place. And most probably this is going to happen in next 10 to 15 years. Impact of wealth creation, that is wealth effect. Now, so much of wealth is being created. What is the wealth effect? Consumers spend more as the value of their assets, such as stocks and real estate, rises. Increased spending occurs because people feel more financially secure and confident, even if their income has not changed that much. And wealth effect defies precise measurement, but people are very stingy or very slow to sell their assets and spend. But still, in US, the experience is anywhere between 2 to 6% of the wealth created. If they have created $10 million, they will sell about $500,000 or something as their expenditure. So that has been the expenditure. In India, I think the story, so this is how it works. Stock market wealth creation increases, wealth effect, and then wealth effect leads to the expansion of real economy, and then you have the corporate earning. Because there is an expenditure in the real economy, corporate earning goes up, corporate earning takes to the, again, wealth effect. So it's a circle which continues, becomes bigger and bigger. So wealth effect in India, what's happening? Currently, wealth in India is highly concentrated at the top. Only maybe less than 5% of people have serious market cap benefits. So the first signs of wealth effect is visible in premium homes, luxury cars, lavish weddings, and these kind of things. You know, very, very high-end discretionaries are completely out of, the demands are very, very strong. Retail participation in equities and mutual fund just about started 5 years back in a very serious way. Expect full impact of wealth creation, wealth effect in a broader economy. It will gather momentum, but I think it will take few more years before it becomes much more broad-based. So the illustration how it works is that market cap in 2025 is say 416 trillion and 24 is 389 trillion. And the change is about 27 trillion. 5% of that is somebody spends. That's about 1.35 lakh crores. And on 331 lakh crore GDP, it's about 0.4% of GDP is the additional. You might be seeing the RBI economists, they are all getting wrong. The first quarter GDP growth was 7.8% when they said 6.5. The second quarter, again, they got it wrong. The economists, they said 6.7 and it came to 8.2. Probably not all, but some portion of that is being explained by wealth effect, which current economists are not willing to acknowledge that much. So what is the India story from NTD to MTD? So this is the story which we wrote in 2008 about the India, the next trillion-dollar opportunity. 17 years, it took a little longer, but yes, it happened. It went from 1 to 4. And several potholes on the way. I mean, like, look at global financial crisis. The moment we started the study, there was a global financial crisis. Then policy paralysis, the government became, UPI 2 became completely dormant. Then demonetization, then teething troubles of GST, IBC, RERA, and then finally the COVID was the last. So we had a lot of problems. It's not that the problems are not going to come. Name of the problems will be different, but problems will come. So the above caused a delay in US 4 trillion by a few years, but it did happen. So this is how it happened. So last 17 years, your Nifty EPS grew by 8% and market cap went up by about 10%. So it is a very slow build up of about 10% in last 17 years. Now, when we move from here, from 4 to 16, in next 17 years, now we are not economists, we don't have any way to say it will be faster or slower. We are saying 17 years it took last time, let it take 17 years more in the next, from 25 to 42. But the delta is not 3 trillion. This time, in the same 17 years, almost on the same population, the delta is $12 trillion. So it is going to have a very different impact in the economy. And that is the core of the study, NTD to MTD. So this is how the saving tsunami. So in last, India in last 17 years, they saved about 13, 14 trillion. In next 17 years, we'll save about 45 to 50 trillion dollars. So there will be tsunami of savings in next 17 years, and that we can see already in the marketplace, because from that pool of savings only, extra money is coming towards the stock market. And where the India's market cap could be headed. I mean, is headed is wrong, but it could be headed. So in last 17 years, the market cap has grown at the rate of 13%. From 52 lakh crores, we are sitting on 416 lakh crores. In next 17 years, if you go at the same pace, we could be sitting on 3,000 to, I mean, it's very scary to say these numbers, but this is the maths. At the same pace, it could be 3,000 crores of market cap, and still counting from there. So I think we are into kind of a really exciting journey as it happens from. And what happened last time? It turned out to be 2-3%, 2-3 years later. This time, same thing can happen. It could be 2-3 years earlier also. If you don't have so many potholes, you may be a little earlier, and if you have a deeper potholes, maybe 1 year or 2 later. Instead of 42, it could be 45. But my sense is journey is on big time. We got to be tightening our belt and get ready to travel in this futuristic journey. So bottom line, exponential multi-trillion-dollar opportunity for most sectors, especially financials, including capital market and consumer discretionaries. Need to identify suitable stocks to play the NTD area. So learn from the sectors and stock. So now we'll talk about how to look at this. So identifying compounders. So we said, what is the compounder? I mean, we said to figure out what is going to happen in future, let's look at what happened in the past. So what was our experience of building up companies, sectors and companies between 2008 to 2025. So what are the compounders? What is the definition of multi-baggers over a period of time? And I think there are a lot of practitioners here, Sanjay Bhattacharya, Ramesh Damani, Sunil, they are the guys who really pick compounders in their life. So we'll quiz them in terms of how to pick them. But that's the real fun of coming to the market. You buy something for $100 and then it becomes 1 lakh, 2 lakh rupees in 3, 4, 5, 10 years time. Shares in high quality companies that can be held for an extended period, allowing capital gains to generate further returns by practicing buy and hold. And so that's the compounding. We have looked at the companies which have given more than 15% return over the long period of 17 years. So just for this is a little busy. We have started the base year of 2008 with 500 companies, and we have looked at companies which have given more than 15% return in last 17 years, and we have come across 35 companies. These are the compounders. I mean, there can be, I mean, from a small cap, mid cap, you can find some more, but it's just illustrative 35 companies. And which are the companies? I mean, I was fortunate to participate in two of them, Bajaj Finance and Eicher Motors. Bajaj Finance has given 39% compounded. Now, 39% looks not that great, but 39% for 17 years. Can anybody count how many times it is? 269 times. You bought for a lakh rupees, and it is worth 2 crores 70 lakhs, and it's still counting. So this is the kind of power of compounding, and the smallest is 3M at about 16%, which is about 12, 13 times. So I think a lot of excitement is there. It is much easier to look back and figure out this all happened. But like me, I participated in Bajaj Finance, but in 4 or 5 years' time, I sold out. I bought it about 5,000-6,000 crores market cap and sold out at maybe a lakh crore or something, which is now 6 lakh crores. So that's the way. Eicher, I bought it about, I think, 10, 15,000 crores kind of market cap, sold it about 80, 85,000. So how do you find multi-baggers or compounders? So what are the characteristics of these compounders? Compounders are few. You're not going to get, like out of 500 companies, you can't get some 200, 250 companies as compounders. So compounders are few. They are rare animals. First, they're just about 7%, 35 companies. Of these 35, 25 are from sectors with tailwind. These companies, they grew much faster than GDP growth rate. Their sales grew much faster than GDP growth rate. 21, 60% are from consumer-facing businesses, all B2C businesses. And 27 companies were market leaders in the base year of 2008. They were the companies which were leading in their own sectors. So, because for a long haul, you must buy only leaders. 28 enjoyed 15, they were inherently profitable also in 2008. And 19 had P multiple lower than Nifty P, which is about 17, 18. And so 19 had a low P, and even other balanced companies, they had multiples which were far more reasonable. So how do we identify the winners for the multi-trillion dollar era? Trend in per capita. So let's look at two things. Trend in per capita GDP and sector grouping because of that. So our per capita GDP in this period will go from 2,500, 2,600 to more like 10,000 if everything works as per the expectation. And what happened in China? In China, in 2007 to 11, they grew their GDP at about 21%. Something crazy happened. But during this period, their per capita went from 2,700 to 5,000. So that's the period which is there immediately in India. Now, what really happened there? Cars, they were selling 5 million cars. It went to 10 million cars. And it grew at about 21%. Home refrigerators from 44 to 87 million. Air conditioner from 80 million to 140 million. Home washing machine from 40 to 67. So these kind of explosions are going to happen in various sectors. Motorcycles went flat because people started buying cars. So, but the basic necessities like salt, refined sugar, they start stagnating or they start degrowing or growing at about 1 or 2%. So this is what happened in China. So we have looked at discretionary build-up, and here we have put 3 categories: autos, capex, consumer-facing, and financials. Then, if you read the detailed report, I mean, I can go on, but in the detailed report, we have talked about financials, which is going to be very, very exciting, because in financials, particularly the capital market, what is happening is capital market is one business. Even if you don't spend anything, then also you end up paying out of your AMC fees, wealth management fees. You don't have to spend. It automatically, you have to. So this is a very different kind of a business where you, this is a cumulative business where your assets, your subscriptions flow, and then it gets accumulated, And the asset management companies, they start making money out of the accumulated asset, and that too on top of on the mark to market also. So that's why worldwide, largest AUM companies are like 50% of US GDP, 12, 13, 14 trillion dollars under single belt in BlackRock and Vanguard and things like that. So financials are going to be very, very interesting in the era of tsunami of savings. Then insurance, two-wheelers, passenger vehicles, realty, healthcare, food tech, and quick commerce. So we have given a lot of slides in the report. It will take a lot of time for me to go through this, but better take a copy and read all of them. Suggested stock picking. So again, we have used the QGLP framework, which we wrote in 2013 about quality, growth, longevity at reasonable price. And so the whole theme is market leaders at defendable valuations. That's the thought process as on today. And this is just a suggestive thing, how to think about picking stocks. We were avoiding, for regulatory reasons, to talk about stocks, but we said let's put best foot forward and put some names so that people can understand how to think about it. So we started with the 500 top market cap company again in 2025, and finally we have built a portfolio of about 30. And this is how it looks. And the moment we wrote this name, Indigo, and then all these troubles happened. So be careful, you know. But still we are not removing. So clearly, I mean, these things are for very long term. They are leaders. They will come back. The whole nation is dependent on them. So a lot of these companies are there. Look at them. A lot of them are popular. But actually, this doesn't stop you from buying companies which are large and unpopular, and also buying companies which are small and growth oriented. That's where you are going to make tons of money. These are the very popular companies. Most likely, some of them will do very well. But the real opportunity outside this thing will be large and popular and small growth companies. And we have talked about sector. Here we are talking about financials, banking and insurance about 20%, capital market another 20%. So we are giving 40% weight here. Auto about 13%, capital goods 10%, healthcare, insurance, realty, airlines, cables, consumers, e-commerce and telecom. That's how we have put 100% allocation sector-wise. So to conclude, I have come to end to the presentation. Concept of wealth has changed from physical assets to paper assets. Get that in mind very clearly. The world is getting wealthier. इस सब channels में आगे लोग इतना मंदी करते हैं, दिमाग खराब करते हैं सबका. I didn't say your channel. So just the rhythm of wealth creation and rhythm of value creation are different. So there will always be fight. There will be value creation is very, very compounded, long term, and price movements are absolutely on a daily basis. So you have to be very, very careful. The world is becoming wealthier and India is becoming wealthier faster. There is no absolute upper limit. ये ध्यान रखना बहुत जरूरी है. There is no absolute upper limit to financial wealth, albeit with potholes on the way. Potholes will come. Please don't take it as given that, yes, we are going to go from here to there. There will be challenges and they will come with different definitions. Last time it was GFC, COVID. This time it will be something else, maybe geopolitics. Already there are so many of troubles. So, but it will come back from there because the machine of securitization, the financial wealth, is extremely strong. India's GDP quadrupled to US 4 trillion in the last 17 years. In the next 17, it can quadruple again to USD 16 trillion. In the multi-trillion dollar opportunity, financials, including capital markets and consumer discretionary, will see explosive expansion as they hit the tipping point one by one. In India, everything we consume, the penetration rates are 10%, 12%, 15%. So all of them, they will start getting consumed. You see today's Nestle interview, the MD is also talking about, they're also becoming aggressive in India. And the MTD era will see many compounding stocks. And so I think the stock market game will be very, very powerful, very interesting. And inclusion of retail, which is happening for the last 5 years, that's one added force to the in last 17 years, it was not there except for last 3, 4 years. But in next 17, it will be in full force. So I have no doubts that in next 17 is going to be far more exciting. It could happen a little earlier, but let's not be more optimistic than whatever has happened. We'll have a very, very interesting journey with a lot of compounding companies. Thank you very much.
Thank you, Raamdeo ji. That was a really insightful. It was a really insightful presentation. I mean, whenever you present your wealth creation studies, it really opens up our imagination. And I still can't get over that statement, which he spoke about a week back. And I hope I get it right, and I'm sure I'm going to get it wrong. He said the potential for wealth creation is infinite. The only hurdle is human doubt or human imagination. So I think that's a very, very powerful statement which comes from this study. We have some time before the panel. So we have, the privilege of having Raamdeo ji to address your Q&A. So if you put up your hands, we can quickly reach a mic to you. I'm sure, the study has been very thought-provoking. Yeah, we have one hand up there. And Raamdeo ji will need a mic. Rohini.
Hello. You can hear me? Yeah. Sir, it was very interesting and very forward-looking. I just wanted to know, you talked about what are the risk factors in this entire journey. If that, broadly could, throw some light on that, that would be also very useful. Thank you.
Yeah. Okay. Good question. Actually, I tried to speak so many times. There will be potholes. Like what happened in last 17 years. We had, immediately we wrote in 2008, and then after 12 months, GFC happened, global financial crisis. Market crashed by 50%. Then in next year, it came back. Then the UPA 2 went into policy paralysis for 5 years. Then came the Modi government. They came with a lot of band baza barat, and then we had demonetization after 2 years. Then after that, all this IBC and all, and then finally we got COVID. So these kind of things have happened. Now, those things, they break down in the sense that the pace at which the car is going, it hits a bump. So these kind of things will happen. And it could be more severe because now India is far more prominent and the games have become much bigger. And so I would think that many more varieties of potholes will come. When it will come, at what frequency it will come, I have no idea. And most likely it will be not a repeat of whatever has happened in the past. It will be new ones, but there is an infinite number of problems which are there in the dictionary for it to come.
Sir, just to take this, good evening, just to take this presentation of yours for last 25 years, I think so there should be a psychologist also here because the biggest risk here is the behavior. And that really tends, to, not making such kind of wealth what you could have created. And that's the biggest risk, I think so. Thank you.
So, the whole idea is to open up the minds. First, open up my own mind and then communicate that to others so that when you're sitting with a compounder, see, you get very few compounders in your portfolio. You cannot read this study and figure out this is the compounder. You have to actually experience compounding, All the practitioners will tell you that you have to experience compounding. And when the compounding starts happening, don't go and break the compounding by booking profits and all. Because it is also said, you don't lose anything by selling at profit. And in the process, you kill the compounding. So, you are not going to be lucky to have 20 stocks compounding portfolio. That's not possible. Whatever one or two you get, and these kind of studies, they open up mind. Maybe I may not be able to sit for 15 years, 20 years, 30 years, but at least let me prolong it from 5 to 10. The guys who are selling it in 2, 3 years, let them go to 5. The guys who are selling in 5, let them go to 10. Because India's journey is compounded. See, the real insight of this story is that the world is compounded. And India is lucky to be very compounded, and hence the entrepreneurs and companies are also compounded.
Hi, sir. Firstly, it's my pleasure to be here. My question is that given the kind of stocks that are entering the listed space, and as you rightly mentioned that we have such a huge penetration opportunity, do you think looking at the valuations with the traditional metrics like P ratios is still relevant, or what is your opinion about it? Thank you.
Yeah, I mean, see, there are two aspects. One is availability of data about every company is immense. When we started, there was nothing available. In fact, the balance sheet used to come after 18 months, and that too it used to be thin. So getting balance sheet itself was a problem. That was the only source of data. Today, you can get balance sheet, and there is absolutely no dearth of data. There are a lot of interviews. There is a screener. There is a quarterly deck of the company. So you are fully provided. In fact, there is too much of data. So that is a change. But opportunities are also many. Economy is growing. Companies are growing. The issue is that are there some useless stuff? Yes, lots of junk. So you have to be smart in picking up those stocks, having your own thought process, having your own philosophy, how to pick stocks, and then go about doing it. So it has become a little bigger jungle than earlier. Also, it was jungle. It was a dark jungle. Today it is bright jungle, but jungle is very big.
But sir, I had a follow-up question. How relevant is the Buffett ratio now? Because he talks about market cap to GDP, and generally, above one time, he starts getting a little cautious. But with most companies going multinational, should the range be revised upwards or?
Yeah, clearly this book clearly breaks that particular glass ceiling. Till about 2000 when he wrote that, he talked about the ratio in Fortune magazine. Clearly, that was the wisdom, because if you have seen the chart, till about that time, nobody had really exceeded the one-time GDP. In Y2K itself, it went about 1.3 or 1.4. And then again, it crashed to less than half or something like that. So clearly that experience was that, but nobody looked at the history that it started from literally 0.1 or 0.2 to 1, and then it is headed for 2 or 3 times. So I think it was clearly that ratio is now has to be recalibrated, and I would rather believe more this author than our own guru.
Right, great. Any further questions? Yeah.
Well, we saw what has happened in the past. That was a very good portrayal. But how has been Motilal Oswal's portfolio based on your recommendations? How much has that grown based on your model portfolio over the last 10 years?
My portfolio.
When you say Motilal Oswal portfolio, are you talking about mutual funds or his personal portfolio?
Okay, let's speak of mutual fund recommendations and also direct equity investments. For example, you have a model portfolio and you keep changing the model portfolio, asking investors to exit and invest. So based on that, what has been the growth as for Motilal Oswal's recommendations?
Yeah, so now Motilal Oswal has become a kind of a multi-business kind of situation where we have asset management company, we have a sell-side research. So basically, you get to see the sell-side research and the model portfolio run by Gautam Dugar, head of research, and IE team. So that I think Gautam, are you there? I think so. Have you done a good job? So I think he's the guy who can explain, because that is the only portfolio available to the public.
Because otherwise, the mutual funds have their NAVs. We have a lot of products, so you can, it's publicly available. The last 10-year CAGRs will differ from fund to fund.
Yeah, I think Gautam can give.
So we've been publishing our model portfolios every quarter where we make changes, modifications. If my memory serves me right, for last 10 years, we have outperformed our benchmark by a alpha of 2.5%. So if BSE 100 would have given 11% CAGR returns, our model portfolio would have generated close to 13.5 or 13.6%. And we don't change model portfolios frequently. We change only 4 times in a year when we publish our previews, which is 7th Jan, April, July, and October.
Yeah, super. There's a hand up there. We can, two hands.
Yeah, please. No, no, I think
You're
you
getting
wait
the
for
mic there. Not over.
Good evening.
Good evening.
Sir, my question is, I have a PMS in Motilal Oswal also, and I am doing investment in mutual fund. And myself, I am an individual investor, trader also. So, lot of time I see market don't respect the earning, like current phase 1 year. And in your portfolio also, I see there are few companies where earnings are negative. There is haywire in earning in next 18 month or 24 month also. Recently, you have added Ola Electric also. It is in your small cap and large cap fund. So as an individual investor, I have a limited restrictions also to meet the management. So, but can, as an individual investor, we should bet with such kind of opportunity where, you know, we don't have a foreseen, but okay, by luck we can bet, like you bet in Zomato when there was you know, negative earning. But after that, Zomato is right now is multibagger also for you, and still you are holding in your portfolio, eternal. So sometime as an individual investor, I also confuse, should I park my entire money with the AMC, PMS, or I should, you know, have limited individual investor mentality, like I should go with the EV, beta, earning, P ratio, quarterly result and all. So this confusion always create in my mind. So last year, you know, I am running such kind of confusion in my mind, whether I should sell my investment. Lot of companies are available at dead cheap rate, or I should go with the PMS only.
Yeah. So good question. Actually, this is a practical question. See, first thing is, let's break it in two parts. One is when you are picking stocks, and one when somebody else is managing the portfolio, that is the mutual fund guys. So mutual fund guys, they have full time, they're professionals, companies come here, analysts are there. So all kinds of facilities are there which is required to pick stocks and hold on to them. And so it's a full-time work. When we started our career in 80s, there were no mutual funds. So we had to necessarily learn picking stocks. Now you are a doctor, you are an engineer, you are professional, you are full-time busy in something else. You should be whatever businessman you are. So you don't have enough time to take care of the, what you call it, stock picking. So you don't have to actually bother so much about figuring out EV, EBITDA and all that. It's a very complex thing. So if you're very passionate about it, it's your hobby, then obviously 10-15% of your portfolio you can try with the individual stocks, and rest all you can give to the professional. But if by chance you're so good at it, your God has gifted you, despite you spend only 10% of time, but you beat them hands down, then obviously you must leave your profession and get into this only. Because then here you're so good, you can manage lakhs of crores. We will hire you, or we'll do partnership with you.
Yeah.
Raamdeo sir, thank you so much for sharing these insights. You shared a lot of stories about companies which have created like 100x, 200x growth in like 15, 17 years. My only problem is I am 28 years old. I have a grand total of 7 years of experience. How do young people like me think of holding and investing in companies for like 15, 20 years?
So, yeah, good question. I think I spoke to you yesterday, isn't it?
No.
Yeah.
But I have a very generic face.
Okay, yeah. So, so this is a learning process. I mean, at the age of 28, you can listen to these things and listen to podcast, go to YouTube, listen to Charlie Munger's now AI-driven this thing on compounding. It will blow your head. So if you listen to them, you listen to read this study, and after that you get it, you get it. If you don't get it, nothing can be done about it. So early, I learned, see, I started in stock market in 85. But in 91, Chandrakant Sampath, late Mr. Chandrakant Sampath, he explained me what is power of compounding. I mean, earlier I used to know EPS and earnings. That's EPS and P, only two ratios I was knowing. I didn't know growth. And how does the growth, the compounding works for the growth in the valuation of companies. This was in 91. He explained to me, and I got it in a second. And once I got it, I never left it. So whether you get what it means to be compounding wealth, I mean, all these stories, we are building it up. So it is on that. I mean, it is about the temperament, it is about the character, maybe ask these guys what it takes to become a compounder because they have practiced. I have busy compounding Motilal Oswal itself rather than so much in stock picking. But it's a way of life. It's about thinking. It's about how matured you are in thinking and holding the stocks while you are the patience you bring. You know, it's not about the brilliance. It is about the character of patience which you bring on the table. You learn. I mean, it is very difficult at the early stage, but as you go along, you will see one or two companies which are holding for 10, 15 years, they will create tons of money.
Thank you so much, sir.
Yeah, there's one behind also.
Hello.
There are some hands
sir.
behind. Yeah, after this.
Hello, sir.
Yeah.
So, what are your views on sectors which are duopolies or monopolies, higher concentration with the bigger players? So, in a lot of sectors, if I can mention like IEX, there were government regulations which tried to break that monopoly. Yeah. So, what's your view on such sectors? There are still a few sectors left where there are concentrations with smaller players, with bigger players.
That's the nature of the beast. As the economy becomes bigger, businesses become bigger, and they start dominating. Regulators will come, government will come. Like in aviation, which happened, 65% market share for Indigo. So government has to figure out how to go about building other airlines, which will be bigger than or as big, at least 30-40% market. So I think everywhere government's job is to see that there is enough competition. Like against NSE, they have created BSE. So they will do it. So I think, but then the strength of franchise, the strength of IEX, is strength of the concept of exchange, the monopolistic nature, and unbreakability. If by chance it breaks, then it's not a truly exchange. So I think even government is not interested in breaking them. Of course, it will slow down for some time. So you have to be careful how much you allocate in them. You know, you should not become 70-80% in one stock. So that's where the free benefit of diversification come. But these are the great businesses and compounders, and they can become very large. I'm not referring to only IEX. I'm talking about any exchange business, whether it is MCX, NSE, BSE. All these have a very monopolistic kind of a situation, asset light, growing. So you have to have in your portfolio how much. That's your call.
Yeah, there's some hands at the back. If we can get a mic
I got
there.
a question, sir. Sir, why are we not discussing the parallel economy, the black economy? The black economy is giving us very awkward nights, you know, especially in Gujarat. So is it going to taper down the black economy? The parallel, so the cash economy. There's a lot of cash moving around in the system.
I understand, but this is not a subject matter of the evening. We can probably discuss after the event.
Okay.
Yeah. Yes.
Yeah, at the back.
Who has got the mic?
There.
Raamdeo ji, good evening.
Very good evening.
I wanted to talk about America. And actually this year of 2025, it's been a very interesting year. वहाँ पे सुनते हैं 38 ट्रिलियन का डेट है, मतलब अपने पास तो 2 करोड़ का भी लोन होता है तो we get nightmares. So, what is your opinion and your analysis in terms of America, and what will that have as an impact around the whole world? क्योंकि इतना सारा loan है, and despite that America is one of the best performing markets of this year. And the same thing is happening in Europe. मतलब Europe में इतना सारा problem है, and you see the Polish market, running at 40-50%, Romanian market doing well. So exactly हो क्या रहा है दुनिया में? And Indian market doing so well, और हम लोग last हैं.
So good thing is that in investing you don't have to worry about very tough questions. It's not a CA exam where you have to attempt questions. So here you don't have to bother about these questions. They are very complex, and just what you don't understand, don't bother about it. I at least don't bother about it. I also hear the same things. I also get scared. So the best
बहुत
is...
डर लगता है. I mean, $38 trillion, मतलब क्या होगा? How will they repay this money?
अरे आपको चिंता करने की जरूरत नहीं, वो लोग पे करेंगे. आपको क्या टेंशन है?
Namaste, sir.
हाँ जी.
Hello. Yes.
Very good evening, sir. I'm here.
Yeah. Please.
Yes, I'm Rahul. I'm the founder of GetWork. So we are a recruitment tech company and helping companies to recruit. So this presentation was amazing. So how we as a founder should be placing our bets? Like, we are into the recruitment space. So there are two parts to this question. Like, are there some special bets with the sector wise that we should be placing? And the second part, as you said, that the wealth is going to grow much more faster than an income does. So will there be a shift in mindset towards the jobs where our full-time traders are coming into the market, the retail traders? So how is that going to look like if you can draw some parallels to the different economies that you discussed about, like once they grew from this stage to a multi-trillion-dollar stage? So that's my question.
No, my knowledge is limited to all the financial numbers and markets, and that too I have not visited them. But you can go and visit China. I mean, China is most recent example, and with a very 1.5 billion people, they were also poor just 15 years back. So they have gone through the same pace between 2005 and 25. So I think if you go and visit to Shanghai and talk to them or your counterparts there, I think you will get some more insights what happens when the economy moves from 4 to 16 trillion. And I think they'll give you some insights about that. I would not have any idea about specifically to your kind of benefit.
नमस्ते सर. So जैसे कि आपने बताया कि next 30 years belongs to India.
Hello. Mic.
Hello. Yeah. So जैसे कि आपने बताया कि next 30 years belongs to India and the wealth will be compounded very nicely in the next 30 years. But the thing is the only problem जो ये journey में आता है वो ये है the human behavior जैसे कि सर ने कहा कि जब market गिरता है in last 1 year as well we all know that market has not performed well in comparatively in last 1 year compared to the last 5 years we have seen. So तब जो लोगों का behavior उनको जब दिमाग खराब होता है एक तरह से and panic हो जाता है. So in that situation I am also a learner. I want to learn from you how you manage those kind of situations and how you manage your behavior in these scenarios कि जब आपका portfolio जो बहुत बड़ा रहेगा वो गिर रहा है 20-30% and how you manage your behavior in that scenario.
Yeah, good question. And actually, I have gone through 3 of them. So when we started in 1990, we had 1 crore. That became 30 crores in 19 months, thanks to Harsha Mehta Bull Run. Then it crashed. I mean, before we realized anything, it became 1/3. So we didn't realize, but then finally we said, to make ourselves happy, we said 1 has become 10, forget about 30.
Okay.
Okay. So that was the whole thought process. In 2000, the same 10 became 100. Again, it crashed to 30. We said at least 10 has become 30. Then 30 became 550. It again crashed to 225. So my style, I have been a voracious equity buyer. My clarity about the power of equity is, absolutely 100%. And this is not from today. It is from 1980 or whenever I was doing my chartered accountancy. So that conviction that equities create wealth, and particularly if you have a growing, well-managed companies, they will create wealth. At what pace, that depends, but it will create wealth. So that allows me to go through these downturns and sit through. I don't do anything. I don't sell because we have missed the bus of selling at the top. So obviously, you have to just keep seeing every day declining to by 40, 50, 60%. I call up friends like Sanjay Bhattacharya, Sunil Mehtani, and we have benefit of some more friends. We walk in the morning. We just laugh it out. So it is very important to have good set of friends with whom you can sound, and they will give you conviction, boss, better. Because he's also going through the same pain. Yes. Okay, so I give conviction to him and he gives conviction to me. Okay. That's how it works.
Yeah. Thank you. In fact, Raamdeo ji has taught us that even to go to heaven, you have to first die. So this is the price you pay for compounding at 15-18%. You got to sit through these corrections.
Good evening, sir. Here.
We're ready to...
Hello, give the mic to him.
Can we have the mic to Sanjay and then
we
can go into the panel?
Professor Bhattacharya.
Yeah. So I think this is a recurring question from younger people who want to take advantage of this incredible, benefit in the economy of compounding and so on. And based on some of the charts you put up, I was wondering whether it might be just a good thing to buy the S&P 500, the 500 ETF, because that sorts out all your problems.
Yeah.
You just buy the 500 ETF and sit on it. Tear up the receipt. Chabi kho jaye. Mr. Agrawal called it chabi kho jaye. That's chabi kho jaye investing, and it works incredibly well. You don't have to do anything. Your behavior won't get in the way of your doing stupid things. So just buy an ETF and sit tight. You bought 500 of the largest. He's shown you how powerful that is, how well they've done in the past. Sit on it. What it doesn't do for you is it doesn't allow you to tell lovely cocktail conversations. When you go to a cocktail and you say, oh, I bought this company, it's up 10 times in 3 months. You can't do that with the ETF. So no excitement, but very good long-term returns.
Thanks, Sanjoy. That's a great note to end the Q&A.
Yeah.
We are now getting into a very interesting panel discussion to explore further insights from the wealth creation study. So let me invite on stage Prashant Nair. He's a seasoned journalist with deep expertise in capital markets. I mean, his clarity of thought and analytical skills have helped millions of viewers understand market complexities. We are delighted to have him here to guide today's discussions. Please join me in welcoming Prashant. Let me introduce, our other two panelists. I mean, Ramesh Damani needs very little introduction. I mean, in his own words, he's been an observer, investor. He's an alumnus of California State University, Northridge, and he's been a prominent voice in India's capital markets. He's hosted several acclaimed shows on CNBC like Wizards of Dalal Street. So, Ramesh, please join us on stage. Our second panelist, Mr. Sunil Mehtani, he's been our well-wisher for years, and thanks to him, we get to the Berkshire conference every year. He hosts us there, but he's basically an investor portfolio manager based in Westport, Connecticut. He's been born and raised in Mumbai. He's an alumnus of Harvard Business School, and he's been living and investing in the US since 1985. And again, his investment style has been inspired by the Buffett style of investing. And he's also, influenced in terms of views, our style of investing, which is QGLP. So really delighted to have you as part of the panel, Sunil. Please welcome him on stage. And of course, Raamdeo needs no introduction. He'll be joining us in the panel. And he's just presented his 30th wealth creation study. Congratulations to him. And, really looking forward to this panel. So, Prashant, over to you.
Thanks very much for that. I hope all of you can hear me clearly. I think we're just waiting. Mr. Agrawal has just made a quick run to the bathroom. Should be back soon. We're also, by the way, live on this panel discussion. One of the things what has happened is, of course, Raamdeo took a lot of questions, which means that we can maybe ask our guests all the questions. And of course, we'll try and open it up if you have questions for Mr. Damani or Mr. Mehtani later. But one downside of all the Q&A has been some of the questions I wanted to ask has been asked. But that's okay. Par for the course. We'll have Mr. Agrawal in just a bit here. It's a real honor for me to be here on the occasion of the Motilal Oswal Wealth Creation Study. It's a 30th edition. It's a milestone. And we're all gathered here to sort of, discuss the takeaways, the insights. I mean, the Wealth Creation Studies have really become a sort of landmark document which we look forward to every year. It kind of documents the journey of compounding, the journey of markets, but also, of course, highlights one theme every year. And the theme this year, of course, is the multi-trillion-dollar opportunity, as Raamdeo said. I'm not sure if Raamdeo chose the topic deliberately, given the slightly downbeat mood that we are in. So kind of sort of, to enthuse all of us and to remember that, 1 year does not make, does not make or break investing records, and one should have a longer-term time frame here. What I thought we will do is, I think Raamdeo, of course, has made a detailed presentation on the wealth creation study. I urge all our viewers on CNBC, who's watching us on television and of course watching us on YouTube as well, to grab a copy of the wealth creation study and read it. But I have with me Raamdeo Agrawal ji, Ramesh Damani, of course, is with us as well, needs no introduction, and Mr. Sunil Madhani as well. What I thought we will do is we will ask each of the three to run us through their own investing journeys, how they found compounding stocks over their 30, 40 years of investing experience, how they held on to it, mistakes, if, as they say, mistakes they made along the way, what they shouldn't have sold, what they should have sold, etc., etc. I thought we could look at this investing, this document, the wealth creation study, through the lens of the three gentlemen who are with us here. So with that short preamble, let me get straight into it. Raamdeo, let me start with you, sir. In your document, in the wealth creation study, you say that you analyzed 500 stocks.
Yeah.
And there were only 7% of that 500 stocks over the period that you analyzed, what you would describe as the next trillion-dollar era, right? And that's a long period of time, which compounded at 23%. You moved early. You had a portfolio of 225 odd stocks back in the day.
Yeah.
To a concentrated 15-stock portfolio, which kind of changed your investing life. So I wanted you, so you got onto this idea early. You're putting this in the wealth creation study now, but you got onto this idea, long back. So talk to us a little bit about that. What triggered that transition?
Yeah. So as I said, I was a very voracious stock buyer right from 85, 84, whenever I got little money. But till 94, because of these bad deliveries, one of the problems was, of course, we were buying 1,000 shares, 2,000 shares, but there were a lot of bad deliveries, and we were in broking business, institutional business. So a lot of these companies, my shares will be given to the institution, and bad delivery will come to me. Like that, we ended up making like 225 companies in our portfolio, finally. And then I read Buffett. That was the biggest impact. They talked about focused portfolios, because you should not have too many companies which you cannot understand, not take care of them. So they said 15 to 20 companies good. So I took help of my wife in 95, and I said, please help me bring it down to 15 or 20 companies. And she would methodically every day sell 10, 15 companies. And in a year's time, it took 1.5 years, 2 years to bring it down to 15, 20 companies. And that very year, the portfolio doubled. And then since then, the journey has been few companies and very chunky allocation, 4, 5, 10%. I typically don't want to buy less than 2.5% of my total portfolio. Like even now, if it is a 5,000 crore portfolio, I would like to buy minimum, 2%, 3% of the portfolio in every stock, because otherwise it will not make an impact. So, and then want to sit long, so that's the whole thought process. But it started in 95, 96.
It's almost impossible now, sitting here in 2025, that there was a period of time when Buffett was not as well known as he is now, right? But as you say, you learned about Buffett in 95, about his principles and concentration of portfolio, and that prompted you to whittle down the portfolio to this concentrated stock.
Yeah, so in 94, Sanjay, I keep troubling him always. So Sanjay told me, why don't you just read this guy's annual report? He sounds a little different. That's how he told. He gave me one copy of the report. There was no all the copies. He gave me one copy of the report. We read. We figured out it looks very different than what we know. I think by reading the one report, I realized that we don't know anything of investing. And then we found all the 20, 25 reports, got Xeroxed, and then we read the whole thing. And that changed the life. So now with the internet, blogs, all kinds of gurus are there all over the world. And you can get them on tap. So, and now books are available digitally free of cost. So it all depends on how much curiosity you have, how much you want to learn, and there is no dearth of Gyan. Gyan ki Ganga bahut zabardast bah rahi hai.
कभी-कभी बाढ़ आ जाती है, but it is important and it's interesting. So three names I want you to reflect on: Hero Honda, Hero Motorcorp now, of course, Infosys, Aisha. These are your three iconic multi-baggers. What common early signals did you see across them? If you can kind of piece a thread to it.
Yeah, so my style of investing was always buy high growth, high quality, high growth at a very low price. Very early in stage, but peg one or half peg. Half peg is my, like if the something is growing at 25%, I want to buy it not more than 25p. Preferably 15, 17. I mean, now these P multiples have gone 60, 70. These are new things. I mean, I wanted to buy Asian Paints. Always I liked the Asian Paint. But when I wanted to pay 15, it was 20. So I didn't buy. When I wanted to pay 20, it became 25. And then finally, once I agreed to buy at 23, and again, my dear friend, he said, let's wait for some more time, and it went to 90. So I never made a single penny out of that. So, once you identified a stock, you understand the company, that these companies are going to grow and they're going to create wealth, then you have to buy at reasonable price. I have never negotiated on buying at reasonable price. That is the first thing which I do, and the quality of business to be good. Because of Buffett, quality investing, I always looked at franchises, high ROE. First thing is look at high ROE. Does the company earn not even 15, 20, 25% return on equity? That's my first criteria. Second is, does it have good terms of trade? Like, say, can he connect his money in 30 days? The debtors are not more than, if you have a 25% ROE, but 100, 120 days, God knows what you are writing. So these are the few things I see, and once that is there, then we try to go and figure out from the company what magic he is doing that he can keep earning 25% ROE in his business for not only now, but over the next 10, 15, 20 years. And then we go and buy the company. If we like the company, then I buy the company. The only thing was, once the company goes from, say, 100 to 300, 400, that time some other ideas come because money was limited. So, you would sell that and buy something else. I remember one compounder I bought, that was BKT Tire, Balkrishna Tire. Today it is a very famous company, very large company. But when I bought it, it was a 100 crore company. And I bought it 1p with a 40%, 30% ROE. And there was no taker. I went to the company. Company refused, we don't want to meet you. And then next day, through somebody I went, I met them. They not only offered me, they offered me Rasgulla. And they told me the whole story. Then we bought. The stock went from 100 to 1200 in 2 years. We sold everything. Today it is 50,000 crores. It is one of the best compounders. But the issue is that, do you understand power of compounding? What can happen? So I think we were kid or whatever. I mean, we didn't. But there are a lot of stories, and many more stories are going to happen. That is a beauty of this market.
Absolutely. Mr. Damani, you've spoken about publicly as well, about being early into Infosys, buying Infosys early. Can you tell us what was the thinking then, and what signs could you see that this is going to be a big compounder for you from the time that you bought it?
I didn't know that. I was lucky, Prashant. Thank you so much for hosting me, and thank you, Raamdeo ji. What a lovely study there. Thank you. Let's give him a round of applause again. I really enjoyed this study. I think it's probably one of his best studies that I've seen so far. I think I came, Prashant, when the cement boom was going on in India in the 90s. And even my jobber knew the price of cement in Raipur and Bhopal and Coimbatore, and I didn't. And I was an MBA from America, so it was pretty embarrassing for me. But luckily, I used to work in the technology industry in America, so I understood technology in India. And most people in India want plant and machinery and, fixed asset base. I understood intellectual property, understood the value arbitrage. So we happened to buy a little bit of Infosys at that time. And that turned out good. I think the journey of compounding started a bit later than that. That was my first lucky foray, which made me a lot of money. But I think the understanding came much later. But to add to a point, when were you introduced to Buffett? I always find that very fascinating because you all are Buffett fans. Raamdeo said 95. In 1977, I went as an MBA student to America to study from MBA. I'm actually old guy, so I went in 1977. And most people going to Los Angeles in those years would tell the local host, take me to Disneyland, take me to Hollywood Walk of Fame, take me to, the tech industry, whatever. I remember telling my sister to drive me to the See's Candy store. There was one See's Candy store in that area, and there was one Walmart in that area at that time in 77. So obviously I'd heard about Buffett. I don't know how, but even when I was 20 years old, I'd heard about Buffett. But it took me until maybe 85, 87 to kind of understand that this guy was actually something extraordinary that he was doing.
This is 77 when you kind of...
1977,
wow.
yes.
And he kind of migrated away from what he used to call cigar butt approach to kind of buying high quality stuff?
Yeah.
That had already happened? I mean...
No, it happened much later. He bought Cap Cities in 1985.
Right.
And I know some uncles that bought Berkshire Hathaway stock, and they told me they bought Berkshire Hathaway. But in the 87 crash, they had sold it.
Right.
And then they were very happy because it had gone down from $3,000 to $2,500. And today, of course, it's some other number, so let's not discuss that pain. But I want to make this point and ask you and the rest of the audience. When I was a student in America, the price of Berkshire in 1977, I checked it afterwards, it was $75 a share. So 1,000 shares would have cost me $75,000 to buy in 1977. Can anyone tell me what that investment of $77,000 in 1977, $75,000, is worth today? And please don't use your smartphones. Just raise your hand. What do you think
or
it's worth
ChatGPT.
No. No, don't put ChatGPT on it. Just anyone raise your hands and tell me that if I had made 75,000 investment in Berkshire and gone and sat at the beach, played the craps table in rural in Las Vegas, or bummed around the world, what would I be worth today? Yeah, you know you're a cheater. He knows, of course. He's a Buffettite too. See, the fact of the matter is that the stock is at $750,000, and that $75,000 has become 750 million USD. 750 million USD. That's about 250 million short of $1 billion for doing nothing. That's the power of compounding. But there's a corollary to that, that the longevity of the compounding is what makes you money. So while Buffett's stock has gone up at 20% compounded for 45 years, the 45 years of compounding has made it into 750 million.
Mr. Damani, when did you finally grasp this idea about compounding and the power of it? Was it...
As you know, surprisingly, his and mine journey have been the same. As Chandrakant Sampath explained to him compounding, he explained to me, imagine a guy who probably didn't pass college in India, explaining to MBAs and owner Motilal Oswal what compounding is and what it does. He used to come to my office and he'd like to have a cup of coffee, and I would give him a cup of coffee, then he'd explain to me how this company will compound, how Lever will compound, how Colgate will compound. And it seemed bizarre to me. He would tell me that, and he would tell me, Ramesh, you're very young, avoid depreciating assets, buy appreciating assets. You know, I never kind of understood that till many years later. So it was a slow burn, if you will. I wish I'd learned it at 77. I didn't. But probably around the same time, Raamdeo kind of understood Buffett. I started understanding Buffett.
Mr. Damani, let me ask you this. I mean, it's a much abused word, but multi-bagger, great compounder, in your career, best captures the power of it staying invested through cycles?
I mean, there are a lot of stocks. India has given us such a great opportunity. Sometimes I feel like hitting fish in a barrel because there's so many multi-baggers and compounders. It's actually unbelievable how many multi-baggers you got. But the one that I think that people don't know and I think they should study, in fact, I would urge Raamdeo to do a special study on that because it's created that kind of wealth, is a company we bought in 96, 97 called Bharat Electronics. I bought it after it IPO'd at 40 bucks. It went to 20 bucks. At 40 bucks, it had a 5% yield. At 40 bucks, it had a 5% yield out there. I think, if I'm not mistaken, if you bought 100 shares, I think they're worth 25,000 shares today by splits, bonuses, whatever. And at for 400 rupee price, that's about 1 crore worth of investment. It's about 28, 30% compounded over long periods of time. And to address a more fundamental question, Prashant, people often say, oh, gold has been in the Sensex and all this kind of nonsense I keep hearing from people. Now, here's the fact of the matter, that when you buy a securitized asset, as Raamdeo has pointed on this study, not only do you get the splits and bonuses, but you also get dividends. So if you had bought an ounce of gold in 1980 at $1,000, today it's $4,000. All you got is the price appreciation in the gold. If you bought Bharat Electronics or HDFC Bank or Reddy's or Apollo Tyres or whichever stock there, the splits bonuses would have increased your value dramatically. The P ratio would have inflated your wealth. And the dividends would have added extra 2-3 percentage points of return. So I think people conveniently tend to forget that. I think over 150 years, I think gold's given 3%, equity is given 11-12% without dividends. So you know where you should put your money.
No, absolutely, and I think that's very, very well put. Mr. Matani, you're a Buffett fan, and but you're also a US market investor, right? I mean, you've been investing for a long time. Right. What were the first true compounders you owned, and what made you trust them early in that sense?
So let me back up a bit. Is it okay?
Will you speak into it, sir? Maybe, or...
They'll control. You speak.
Is
they
the
can
mic
control?
on?
Okay.
Yes.
So, yeah, just backing up. So I went to the US in the early 80s and first heard about Buffett in the mid-80s. Raamdeo, I think you said 95? So I had a big lead over him. In 1987, there was a book that came out called The Midas Touch, which is the first biography. And when I read that, I was completely hooked. And the first time I went to Omaha for a Berkshire meeting was in 1994. Wow. And I met Raamdeo soon after that. And I think 1999 is when he first went. And I've been going there with him every year since. I follow him to carry his suitcases. But so I discovered Buffett before he did. And I went to a Berkshire meeting before he did. Somehow he's become a multi-billionaire, and I'm still sitting here. So there's, obviously something off here. But the learnings have become very clear over time as to what the approach is. One of the things that Buffett repeats almost every year is the confidence he has in America. And he says he'd always bet on America, he'd never bet against it. I think that if he was sitting here today, seeing what Raamdeo has been talking about and understanding the facts, he would probably be betting on India. And I think that's it's a great place to be right now, because the US's best days, I think, are behind it. It'll still grow, it'll still do fine, but not the way India will. Yeah, so then I'd like to ask Raamdeo a question about his study, if I may. So, Raamdeo, you talk about the wealth creation, and you talk about the movement to paper assets and securitization. But that's not really what wealth creation is about, in my view, in the sense that you had in the report, I think, a number which said that the market cap of all the securities in the world is about 147 trillion today, right?
No, not now. In 2001, it was about 123 trillion. This is only market cap.
Only market?
Yeah. So today it is about 141 trillion, global market cap. 140.
Yeah, I saw 147.
170. Yeah, something.
In any case, if tomorrow,
yeah,
everything goes up 10%.
Okay.
Has 15 trillion of wealth really been created? Because the wealth creation.
That's how it is created.
Yeah, but that's on paper, right? Because if the next state goes down 10%, has the wealth been destroyed?
Yeah, of course. I mean, if you are calculating your wealth on a 24 hours basis, that's what is happening.
Right, but the way wealth is really created is by stuff happening at the micro level, right? I mean, an easy example is productivity on a farm. Yeah. If a farmer is making ₹1 lakh of crop every year from his land, and you can show him more productive ways to do it, so it becomes 5 lakhs a year. That's wealth creation.
Yeah.
If a company grows,
yeah,
that's wealth creation. So the things that have happened here is one big thing has been access to capital for entrepreneurs, right? It's much easier now for someone with a good idea to get the capital and to start a company and to employ people and to create new products.
But from where this capital is coming? It's coming from the wealth.
No, that's right. It's coming from savings, etc.
Yeah.
But how is additional wealth created?
Yeah, I'll tell you. Look at don't go very far. Look at Motilal Oswal. Motilal Oswal, my net worth is about 12,000 crores. Okay, that's lying in the business. It's busy with all kinds of working capital, this, that. But my market cap is 60,000 crores or 50,000 crores. Today, I want to donate 1,000 crores worth of for a hospital. Can I take it from the till, or will it do it from the market cap? I will do it from the market cap. Right. And the moment you spend, say, 2% of that for building a hospital, now the economic engine starts. Because the company is working without any problem. But this 2% is going and creating a hospital. It is creating jobs for hundreds. That's how America became rich. That is the power of securitization. See, securitization is a machine of foreseeing the future profits and the present value of that. See, if I am not capitalized, there is no question of you bothering about what could be the value.
No, that's right. But the action that created the wealth was actually doing something in building the hospital and creating the jobs.
Beyond doubt. Right. There is a securitizable asset.
Right.
So if the world over, there are assets which can be securitized. These roads can be securitized. The companies can be securitized. The issue is like in US, now USSR, there is no securitization. The whole economy is one of the largest economy in the world. There is no securitization. That machine is gone, shut.
Yeah, but all of that is a tool for creating the wealth, right?
Gentlemen, if I can...
it's not the wealth itself.
Yeah, so
I have 3 pages worth of questions. If I can...
Please, yeah.
get this, it's a fascinating discussion. I think, Mr. Madani, you make a valid point. And maybe we, towards the end of it, come back to it. Okay, now we kind of talked about how all of you found your first compounders and what was the common thread. In that sense. Now let's talk about mistakes, missed opportunities and what did not work, which I think is also equally sort of important. Raamdeo ji, is there a stock you regret not buying or holding longer, where hindsight sort of, taught you more about conviction?
Yeah, so one of the, with a lot of conviction, I bought HDFC Bank in 95. I think it came out with public issue in 95. It got listed at 40 bucks, 200 crores the equity. So it was available for less than 1,000 crores. And it was so liquid, you could buy any number of shares in a minute. So I bought about 5-6 lakh shares. And I had a great dream that the next HSBC, see, I had gone to Hong Kong and seen the HSBC building. So I said, our HSBC is going to be HDFC Bank. So that was my thought process. And I read the book, Value Migration. So I was very clear that value is going to migrate from PSU banks to private sector bank, and these guys are the most credible guys. So all kinds of things I had thought through, bought it, in fact applied in IPO. I never applied in IPO. Here I had applied. So I bought at 40 bucks, and at about 52, 53, I got a inside information or classified information, not inside, but some right information I got that NetWest, which was the partner of HDFC Bank, is breaking up. I said, these guys, they don't know banking. And if we loved so much multinational, if they are going back, then I think the whole damn thing will come down. I sold it. I sold it 52.5. I think in lifetime it has never come below 52.5. Okay? It took me another 6 years to get back to making money out of, HDFC Bank. But by that time it was already up 20-30x. So that's how you...
But what's the learning from this? I mean,
learning is that you should stay with your conviction.
No, but did you have conviction at that point? Because
I bought 5 lakh shares. I mean, you can imagine 5 lakh shares is a lot of money for me at that point of time.
Right.
So I had a lot of conviction. I had thought through everything. I read the book. What more you want? But the issue is that we didn't have this understanding of compounding that deeply. We didn't have experience. Money was limited. Loss-bearing capacity was limited. I thought I'll seriously lose money. And hence, let's run away. And so I could have sold, say, 80%, 90%, held on to something. So that's what I did in Bharti. Bharti, I did ulta. Bharti, I bought 1,25,000 shares at 25 bucks. Again, because of the book. The moment I bought in 2003, 23rd January 2023, I bought 1,25,000. Everybody told me, Raamdeo, it is a useless share. It is not your type of share. Sell it. So by the time it became 30 bucks, I sold my 1 lakh share. I said, this 25 I am keeping. Okay, the momentum of wireless penetration was so massive. In 1 week time, it went to 33, 34. I said, nobody understands. I went 10x at 33. After selling at 24, 25, I made it 10x. and then stock went to 90. Then my analyst left, went to Reliance. From there, he started threatening me. They will crush you. Okay? So I again sold 50%. In 3 months' time, it became 140. Again, I went 4 or 5x. And then I sat right till 1180. This all happened in 2.5 years. So the compounding, if you sit through, when the business gets momentum, tailwind, momentum, terrific execution, economic this thing, it's a crazy wealth machine. That's what happened, 1180. Then 2G scam happened. The stock fell down to 625. I sold it. I made 50x. Oh, sorry, 25x. And so, but then today, Bharti is again, after 10, 12 years, is the largest wealth creator.
In that, yeah.
Yeah, but I didn't sit through.
Yeah.
So I'm not entitled to that.
Mr. Damani, same question to you, sir. Something that you wished that you had bought or you owned it at one point, you sold out early, and then you look back in hindsight, you say, well, that was the wrong thing to do.
Yeah, Prashant, I have enough thumb-sucking experience to describe. And I think the one that Raamdeo got and I missed, which is no excuse because it's in my circle of competence, it was in my backyard, it was with people who ran the company who I greatly admired, and yet for some reason I was sucking my thumb when Bajaj Finance got listed. I mean, it's just something that I really tell. There's an error of omission, what do you call it? You know, nobody questions me because I'm a prop investor, but I know the hurt of missing a stock like Bajaj Finance. I don't mind missing a Reddy or missing Apollo because those are not my circle of competence. But to miss a Bajaj Finance was extraordinarily stupid of me. In my backyard in Pune, I go there like 3 times a month. You know, I could go and visit any time. I made a mistake there. I rectified the mistake during the COVID. I bought some there. But it was a different feel. I should have been at the get-go of that.
But why didn't you? I mean,
I just missed it for whatever reason. Complacency, didn't do my homework. The fault all is with me, nobody else. I mean, I just didn't do my work. I should have done the work out there. You know, for whatever reason, I was, you know, busy trying to make 10% gain, 20% gain, and miss the multi-bagger opportunity of a lifetime. Till today, it still rankles me.
Thanks for sharing, Mr. Damani. Anything you bought and you sold out, which you wish you did not? I mean, I'm sure there are many, but any one kind of...
I mean, I tell you one thing. During COVID lows, I'll give you a good interesting example of how this thing works. I had bought a stock at 20 rupees a share in 93. The right issue had come at 20, I had applied for the right, I bought it at 20 rupees a share. And I held it unchanged until 2020. So whatever period, I think 25 years, I had it unchanged, didn't buy any more or sell any more. By that time, the stock had become 1,000x, no, 100x. From 20, it had gone to 2,000 bucks. 2,000 bucks, right? In COVID, I was a bit nervous. I wanted to sell something, and the year something was making 100 times my money. So I sold those shares. I said, "ठीक है, कोई बेच दो." I think in the next 6 months, it doubled, then doubled again. If I waited another year, I would have sold it at maybe 700x instead of selling 100x. The stock, for the record, is Apollo Hospital. I made 100 times the money and I sold it. Why did I say? Just because I made too much money and no other reason to sell it. I was nervous. I wanted to create some cash, so I sold it. But I missed out on one of the great compounding stories in this market.
Which is stock?
Apollo Hospital.
Apollo Hospital, wow.
But, you know, the second example, one is you didn't buy. The second is you bought, but you maybe sold out early and you should not have.
Because I made 100x my money. I mean,
absolutely.
That's no reason to sell.
Absolutely. But, I mean, maybe the silver lining is that directionally your thought process was correct. You didn't capture the entire I mean, you know, you buy something and it goes down, then you start to doubt yourself. Here you made 100x, you should have made a lot more.
You can't make those kind of mistakes. Not if you want to be Warren Buffett. You can't make those kind of... Those are unacceptable mistakes for someone at my level.
Yeah.
30 years experience in the market, a stock triples in value after you sell it. And the only reason you sold it because you thought, 1,000 ka bhao ho gaya, 2,000 ka bhao ho gaya. It's not acceptable mistake. I mean, I made it and it was my mistake, but it's not acceptable.
Ms. Madani, if I can ask you, sir, a company that you bought, I mean, a US stock, you expected a compound that did not. If you can share something with us.
There's too many that I've bought that didn't compound. So maybe I should talk about a different kind of mistake, which is one that I bought at a good time but sold too early. So in about 2000, I think it was, Apple. So Steve Jobs had just come back to the company. He'd been kicked out, then he came back. And I looked at the company, the business was making money. They had $3 billion of net cash on the balance sheet after deducting some debt. And the total market cap of the company was $4 billion. So 75% of the market cap was in cash. And they had just introduced the iPod. It was their first real consumer product, even though the PCs were that. But I had this insight. I thought, this is now heading to be a consumer product company. It's no longer a high-tech company of the type I avoid because it changes too fast. So I had that correct insight. Unfortunately, the stock doubled in like 18 months. And I sold it because I had doubled my money. And I think now it's probably 100 times or more that. Oh, the market cap then was 4 billion. What is it now? 4, what?
4,000.
4 trillion.
4,000.
4 trillion. I don't know how much capital, they've been buying back stock in recent years, but it might have been 1,000 times. So that's one that got away just because for the same reason I said, oh, there must be cheaper opportunities.
Prashant, yeah. Let me just add a story. I read about this in the CLSA report this weekend. Same thing. When the Macintosh came out, you could have bought a Macintosh for $2,500 in 1985 or something like that. And you could have bought the Macintosh and it's probably worth zero today. Or you could have bought $2,500 worth of Apple stock. That's worth $5 million today. So again, a good lesson in buying appreciating assets and not necessarily depreciating assets.
Absolutely. But, that experience in year 2000, right? I mean, the opportunity in Apple, I guess, started to crystallize when the iPhone came out. That was much later, about, I think, 2008, 2009, approximately. In the year 2000, I mean, it was basically just numbers. You had all this cash the company had. There was this shift which was happening. So did you have enough information to kind of hold on to or not really?
Well, I think that was part of it, which is, so the stock went from 4 billion to 8 billion, which means that the 1 billion valuation the business had gone to 5 billion. And that's what I focused on, instead of what's the potential of this business, which I should have seen then in looking back. And it's hindsight is easy, but that's what it was. Let me give you one more example.
Please.
Or one that I didn't buy, even though at the time it seemed to me a very cheap stock. And this was in 1989. I was visiting India from the US, and I came across HDFC for the first time. And HDFC then was trading at less than 200 rupees a share, like 190. The dividend, I think, was 18 rupees or something, and it was making 65 rupees a share, 3 times earnings.
It was 100 rupees share.
Stock was 190, earning 65 rupees, paying 18 rupee dividend, so you have almost a 10% yield, 3 times. So I remember talking to my friend Sanjoy Bhattacharya, who's sitting right there, and saying, what am I missing here? This is too cheap. Oh, and it had been growing 25% a year and making 25% type ROE. And I said, what am I missing here? And he said, they don't do stock splits, bonuses, and it's not sexy. And that's the reason. But he said it's a good company. Okay, then I met with Deepak Parekh, who was a neighbor of mine. And he said, I asked him the same questions. He said, yeah, you're right, it's too cheap, it should be 5 times earnings. Even Deepak Parekh thought it should be 5 times earnings. So I actually, I had no money in India, but I told my dad, buy some of this, it's going to be good. He didn't buy it. I think a year later, I still was telling him to buy it. He didn't buy it. Anyway, I don't know what it's done since then, but it must be 1,000 bagger or something.
6,000 bagger.
6,000 bagger.
Wow.
So instead of spending money on a plane ticket, I should have just bought that stock. Yeah, that's right. He said it's a stock for widows who want the dividend. And he thought it should be 5 times earnings.
Interesting stories of commission, omission as we call it. Now, let's talk about your report, Mr. Raamdeo. That study set 500 companies, the period that you analyzed, only 7% compounded at 23%. Why are they so rare? What are the in 2 or 3 points if you can tell us? Why are they so rare?
Yeah, one is that it is minimum 15% kind of a growth rate between 8 and 15. So a lot of companies which are expensive to start with, they would not make it, you know. And second is that in this 35, there's one more condition that it should beat the market in both the segments of 1 to 2 and 2 to 4. That cut out a lot of companies. So, I mean, the whole idea was to get the most authentic compounder. You know, so when you get, like every year, if you are, every 5, 7 years, if the stock is not compounding, typically you don't stay with that. You know, so then it's not authentic compounder. So, but these 35 companies, they have compounded in both the segments. So I think every single filter you put in this kind of thing, they keep cutting down the number of stocks. You know?
Which of the, you say ROEs, tailwinds, leadership, and many more.
Yeah.
As you stand with your experience and, I mean, you know,
Yeah, so-
everything you've done, what factor ranks the highest?
Yeah, so the leadership. You know, because to finish first you have to finish. So if you want to do the journey of 4 to 16, and in 42 you want to be surviving, you make sure that businesses will be there. But businesses, the last to die, if at all it is failure, will be the leader. And the maximum people make, in fact, what happens is the leader company in this kind of situation, they are always expensive. They will always look expensive. If you think there is going to be boom in cement, don't apply your head, go and buy Ultratech. You know, because they have multiple ways of making money. Like in banking, particularly lending, it's very risky. Everybody knew that HDFC is a great bank. By 2002-03, it was very clear. But a lot of people, they went to buy the sidees, all sidees. Somebody bought this, somebody bought that. And there is only one compounder out of the entire private sector opportunity, that is HDFC Bank. So you have to buy the leader, and I have seen time again. It is the leaders which make tons of money or maximum money out of that particular tailwind of a sector. So if you have a stock market tailwind like financials, so this time asset managements will boom. Now don't go and buy number 10th or number 12th asset manager. Go and buy the bluest and the biggest and the best managed. Those guys will do, I mean, downside, they may not be the fastest, but they will be there. They will make tons of money.
So out of all the factors, leadership in their respective industries is, you'd rate that the highest.
Yeah, I mean, once you have identified that this business is potential, the business itself has 15, 20%, 25% ROE kind of a potential, and there is a growth potential, then the company to buy or the management to buy is the leadership.
Don't buy the next HDFC Bank, buy HDFC Bank. That was
the next HDFC Bank is HDFC only.
Mr. Damani, how much weight do you put, sir, on sectoral tailwinds, high ROEs, some of the things that Raamdeo said, when you are looking at opportunities?
Yeah, Prashant, Raamdeo had this formula, QGLP. The one I focus on quite extensively first is P. I'm very concerned, the price discounts everything. So more than leadership, more than ROE, more than P, I'm looking at the price I'm paying for it. Sometimes even if I make a mistake, the price is the cigar butt example. You can still make money out of it out there. And generally I find that if you buy when a bull market is starting, an extremely underloved sector, which means the price is very, very cheap, you will end up making a lot of money at the end of the bull market out there. So almost obsessed. If you ask me about a company or pitch a company to me, almost my first few questions will be what is the market cap of the company? Because that gives me a good starting point. Is it 500 crores, is it 5,000 crores, 50,000 crores, you know? And can I value or see the business at that market cap? So for me, it's P.
And P and of course the market cap relative to the size of the opportunity. I mean, how much?
As I see it, as I see it. You know, if they're in a commodity business, I know the market cap should be this, consumer business should be this. But the market cap is an amazing filtering exercise, you know. Some business I would not look at no matter what, because the market cap is too big for me at this point, for me to understand.
Mr. Patani, again, I mean, which of the studies' compounder characteristics works in the US market where you invest? What has been most sort of pivotal, most important? I mean, if you can pick one or two.
So for what I do, which is, I'm not a technology investor. So I've missed all of the big tech companies. I find myself buying very high quality companies when the price is relatively low compared to their earnings, but they tend to be modest growth companies. It's very hard to find companies that are growing at even 10% plus at decent prices. So the bad news is that the good news is that you can make a good gain out of them. You can make 50, 100% over a couple of years. The bad news is that those are not the kind you would own for 10 years. So you're constantly having to find new investments to replace them. And I'm not happy about that, but that's the way the US market is. The ones where I've made the most gains over time, where I've actually made 8, 10 times my money, which in the US is a lot, tend to be very small market cap companies, below $100 million or 1,000 crore. And it's a different game, but there's many, many more of those there, and it's possible to find those.
Fair enough. Let's get to valuation. Mr. Damani, of course, alluded to some of it in terms of how important the market cap, price, etc. is. Raamdeo, I mean, in the study you say that frothy peas without earnings are what you call unmissable selling opportunities, right? Could you talk to us a little bit about when to sell, basically? That's the question. What's the, is it very high? Because some of the examples you gave, if you're convinced and you have, it kind of fits all the criteria, you hold, and the way you made it seem like is you hold forever. What makes you sell?
The sell is that the logic was to see very high rate of growth. Say like now I can talk about it, like Hero MotoCorp, I bought in 95. And I could see value migration again and leadership. Honda and Hero both coming together and building motorcycle which was fill it, shut it, forget it. It was a complete leadership. They had 70-80% market share, and it was a shortage bike in the sense that there were 3,000-4,000 rupees premium on the bikes. So the stock was about 1,000-1,200 crores, 15-17 P multiple, growing at 25-30, again half peg. So it was fantastic consumer company. You could track it on a monthly basis. So that's how, and the dividend was crazy. Like they were paying 60 rupees, 70 rupees, 100 rupees dividend. So I sat and sat. So I was making money. I sat for 20 years till about 2014. Then maybe the industry also slowed down, and they slowed down big time. And then there was a transition in the leadership. Mr. Munjal passed away. And so I think TVS, which I was thinking was not that great a company, that took off big time. I mean, they started taking leadership from others. And I think Hero MotoCorp and all, they lost a little bit of market share. And TVS gained the market share. And the market started premiumizing the motorcycle, which these guys, they completely missed. And at that point, I said, boss, they're not growing actually at a rapid pace. Their ROE had come down from 40, 50, 60 to more like 20, 25. I said, enough is enough, let me sell it. So I sold lock, stock, barrel in one shot, everything. And then I kind of moved on to other companies or mutual funds and things like that.
Mr. Damani, your style of investing, right? You're obsessing about price. Entry price is supreme and paramount to you. How does that work in the current market environment, in the Indian context in that sense? I mean, if you look at P multiple phases, I mean, I think Kotak or maybe Motilal on the sell side also does this. They look at phases, P multiples across sectors, 2000 to 2005, 5 to 10, 10 to 15. I mean, P multiples have just gone up and up and up, right, across the board. So I just, a large fund manager recently, and I think he said it before as well, he said, well, everything that was to be discovered is already discovered. I guess he was exaggerating to make a point in the Indian context, and I don't know if you, but I just wanted your thoughts. Because
he was exaggerating. He was clearly, I would say that I visit a lot of companies, I try and talk to promoters, and while the market is going through a wobbly phase, I don't think it's giving signs of being toppish. Am I finding opportunities to invest the money today? Yes, I'm finding opportunities to money invest today. Stocks that I'm bullish about. So, I think it's just a bit fashionable when the markets go up to say, oh, top ban gaya, ghad jayega. I just think it's become, the false Cassandras, if you will. And I think markets are fine. They will, as Raamdeo has pointed out so clearly, there will be potholes all the time. But, the big money is made in the big swing, and by sitting through the big swing and riding out the volatility. And that's what life has taught me. So as long as the business is good, just because it's down 30%, 40% is no reason to sell in my opinion. I think you have to go through that pain in order to make a substantial return.
But my question is for people who already own, and I mean, they should sit through it, and maybe P multiples are high and they should not sell, and I take your point. But for those who want to get in now, or those who want to buy, I mean, how do you, and you are very, very conscious about the price that you pay, and you would agree with me that, you know, it's a not, I mean, it's a slightly euphoric market, right? I mean, we are charitable in terms of giving multiples and market caps, etc., to companies. I mean, a lot of money has been coming in. Does that generally, I know it's a general question, we can't be very specific, and there are different situations, but generally, has it become a little tougher with your approach?
I mean, generally speaking, no. I'm traveled to North India, East India, South India, traveled everywhere, and I'm finding bargains across the country in small cap, mid cap stocks. Decent promoters, good businesses earning 100 crores and barely scratching 2 states, 3 states. I think they're going to do well over the next 3 to 4, 5 years. So, I mean, you know, there's always, you know, when the index was 25,000, people said, oh, the index is so high, should we invest now? They said the same at 40. You think about NVIDIA, people were saying that at, you know, $1 trillion, $2 trillion, $3 trillion, $4 trillion, $5 trillion is expensive. I mean, you got to say something you're wrong. I mean, you know, if it doesn't work, you're wrong. So having said that, I study bull markets and bear markets for a living. When the bull market is getting close to peaking out, it gives you some sort of signals that it's peaking out, there's a lot of leverage, a lot of nonsense talk. I don't see any of that happening right now. I'm happy to remain invested with the caveat that, yeah, you could go through a bad space that we're going now. And if you are 25 years old in India looking at investing for the next 30 years, this is as good time to get into equity as was when I joined the market. I'm very clear about that.
Raamdeo, do you want to weigh in? You picked up the mic. You want to add something to that point? What?
Yeah.
Because you also mentioned the point
I was talking about bargains.
Okay.
You know, in this market, you can get SBI at 11p. So there are, I mean, it's staring at you. It's the largest bank. It is part of the, so you have to do a little more work. Clearly, it is not a kind of a depressed market. If the market has crashed by 50, 60%, then of course, all over everything is cheap. You don't have money in pocket. You know, typically that is what happens. You don't have money, and that's why everybody is exhausted the money, and the stocks are a little cheap. But that's not the case right now. A lot of people have a lot of money, and you have to be a little, but you know what happens is there are 50, 60 sectors. Of that, 25, 30 will be in a boom condition, and 25, 30 will be depressed. So the ones which are coming back, they would be available at very reasonable price. So that's about 40, 50% of the market. Other 40, 50% will be sky high. So, but everybody likes what is sky high, what is very popular, what is being traded by every second. So those stocks are not available cheap. But the ones everybody hates, and there is no crowd on the counter, they are the good ones, and they're enough.
Yeah. In your report, Raamdeo, you say that large caps will do well. I mean, that's right?
Yeah.
Broadly, as you look at it. And that kind of...
No, that I said because of one of the slide where the large caps have underperformed the mid cap big time.
Yeah.
Only 30% of the 31% of the wealth created in this study is by the large caps. Earlier, it used to be much larger, 40, 50%.
Right.
So I said this cannot happen.
Right.
I mean, the top 100 companies, they...
So in this, the multi-trillion-dollar opportunity, one of the conclusions is that large caps perhaps will lead. That's...
See, multi-trillion dollar is a different discussion.
Yeah.
In this study, I mean, when we write this report, we also talk about, I mean, whatever is the observation of the data. What we are seeing is that large caps have literally underperformed, and hence there is a most likelihood that they will come back.
Okay.
It doesn't mean that mid cap and small caps will not do well, but large caps will definitely do well.
Mr. Madani, just a quick, brief word on, since we're talking about markets maybe here and now in the US, S&P almost at 7,000. What's the, is it looking all fine, all okay?
So some of it is looking very rich. And I think there has to be a correction there. But I'm surprised at the number of big, solid companies that are the blue chip type, but are not high growth companies, that are trading at relatively reasonable prices. So I think there'll be a shakeout at some point. There's a lot of talk about what's happening in the AI sector. I think there'll be a shakeout. The biggest thing that actually worries me about the US right now is the leadership. Because God knows what this guy is doing, and God knows what will happen next. So I think it creates instability for the country and for the markets as a whole.
Okay, I want to come to identifying future compounders. This is the next 15, 20 years. But just a couple of questions, right? I heard somebody in the audience ask, how do you personally manage drawdowns in high quality stocks to stay detached from the price action? And I think you said, well, have good friends who are going through the same thing and sort of एक दूसरे को थोड़ी दिलासा देते रहिए.
थोड़ा दिलासा देते हैं. दूसरा ये है कि actually you have to see if you understand company well. See, the value creation doesn't stop when the stock corrects. That's what I said. There are two pays. One is the value creation, other is the price creation. Now price can go beyond the value and then again come back way below the price. So that keeps happening. I mean, if the 20p is the right number, it might go to 30p and then come down to 15p. Now at 15p, you have massive pain. But you must understand, it has overdone, it has corrected. So, but then the company's value creation process of 20-25% growth, that's on. So long as the wealth creation process in the company is on, and I think it has a long way to go, I will sit through. And that's what I'm doing with many companies of mine. Some of the companies which I have directly, I'm still sitting on. Because, and then you have to go through this. See, if something has gone to 60p, 70p, it will correct. It is not going to sustain. But the company is growing at 30-40%. So, I mean, that understanding I have very clearly.
We have some of those cases playing out as we speak in markets right now. Mr. Damani, the role of temperament, I mean, would you want to weigh in? I mean, how important is that? How would you rate it vis-a-vis, I mean, reading a balance sheet or being able to analyze a business and prospects, etc.?
It's clearly the most important thing. You know, I mean, as it's been famously said that be greedy when others are fearful and be fearful when others are greedy. I mean, if you can do that, it helps. I think also the difference between being an individual investor like I am and being an institutional investor, it's a different ball game altogether. So my advice is to stick to the individual investors. Institutional imperatives are different completely. I understand that, You know, I made Bajaj Finance mistake, like I told you, Nobody kills me at home for making it, You probably can't do that in a professional environment. You don't want to over-concentrate. You don't want to, overdose. There's so many restrictions you have. So I think temperament is important, and that Buffett didn't manage public money. There's a good reason for it, because he was also the temperament of managing his own money. So I think it's a very important quality, and it's, as Raamdeo pointed out in a study, either you get it or you don't get it. Either you understand compounding, understand value investing, or you don't get it, And luckily for me, I got it, so.
Raamdeoji, talk to us a little bit about where I mean, I think you did in the presentation highlight, right? I mean, I think financial services is one big pocket when you look at this next big opportunity, capital markets, etc., all of it in it, and consumer durables is the other big bucket to sort of look at to identify compounders. Is that correct?
Yeah.
And just briefly the thesis behind both.
Yeah, so see, lenders have been the financial services, particularly banks and NBFCs. They have been fantastic compounder in the past 17 years. And luckily, they have not been grossly overpriced. They're at about 20, 25, 18p, those kind of things. So you get one Bajaj Finance, one Cholamandalam. So like that, many more will come. Because the today credit requirement is about, say, commercial credit is about 200 odd lakh crores in the economy. And it is, as the economy doubles, actually the rise of the credit will be more. So credit growth has to be 1 or 2%, 3% higher than normal GDP growth rate. So the credit requirements will keep compounding. It's a very restricted area. You need licensing. You need scale. It's a game of scale. So, So what happens is that you have a decadal opportunity for the credit expansion at about 14, 15, 16%. So these banks, they will do very well. AIA and all are coming, so maybe there will be cost busting for the operations and all. So they will be there. Who will win? That is a different issue. Then you are coming with the capital markets, where tsunami of savings are entering in. One thing somehow we missed is the retail boom, which has happened from 2020. So till that time, stock market was being participated by only 40 million demat accounts. Unique accounts must have been about 20 million. 2 crore janta, that's about it. Today, we are talking about 215 million accounts. And we are headed to become 500 million demat accounts in next 10 years straight. So that force of savings entering the capital market and hence helping the entrepreneurs create wealth, that was not there between 2008 to this particular journey, NTD journey, only for last 2-3 years. But real, it is booming now. So between 25 and 42, one of the biggest differentiator will be the capital market. And capital market is very cumulative in character. You send 5 lakh crores or 6 lakh crores this year, it doesn't flow through. It goes and gets accumulated in the tank, in the AMC by way of AUM. And then there is a mark to market of 15%. So there are very few businesses like this which are growing in terms of new subscription, and on top of it, there is a mark to market on whatever you have. And that's why BlackRock, Vanguard, they are 12 to 15 trillion dollar kind of a AUM companies. So I think we are going to give birth to those kind of companies with $1 trillion, $2 trillion kind of mark AUM. Now, how much money they make, that's a matter of time. But those kind of large companies are going to come. Wealth managers are going to come, which are going to be very large, because now once you cross 1,000, 2,000 crores, you can't do it yourself. Then you look at a service of a wealth manager who charges another 0.5% or something like that. So that number will be very large. So wealth management, asset management, even broking, then all the intermediaries, market intermediaries, exchanges, they will do fabulously well. And of course, there'll be some corrections, this, that, and they're asset light. They don't require too much of capital. So that's one segment which is going to be new category. And you see that listing grow 1 lakh crore. Today, ICICI AMC, which is another 1 lakh crore. Then BSE is 1 lakh crore plus. NSE will come at 4-5 lakh crore, 6 lakh crore. So I think now this sector is a newly casted sector, and it has a big runway. So I would suggest that compounders will come from here. Second, once your per capita goes up from 2,500 to say 5,000 in next 7-8 years, the tipping point for durables to start. And the biggest durable is housing, and second is a car. So now car, you have seen the Chinese experience from 4 million to 25 million. Right now they are doing 25 million. We will also do it. Whether we'll do it 5 years later or 10 years later, that is only a matter of time. Because everybody needs a personal transport, and there are only 3 companies, Maruti, Hyundai, and Mahindra. So if you buy all 3 of them, then also you're locked into, and all three of them are well managed. So, so those are exponential opportunities. And then you have the individual companies from where air conditioners and all that. So you have to go and see which are the companies which you want to buy. And that's why in the book, we have tried to, every company-wise, the drivers of the industry, and when you select, what are required to be seen. That's all given there.
Financials and consumer durables, and the logic behind it. Mr. Damani, as you think ahead, right? I mean, slightly the longer term canvas, which are the pockets broadly which you think will do very well?
The marginal money that I have, dividends, the extra money from selling, I've been putting into pharma. I find for the first time a lot of Indian companies are developing intellectual properties, filing new chemical patents. I find that to be a surprisingly cheap and exciting space. Rare earths, I think there are not too many players, but there are a few players in India which should capitalize on rare earths. It's going to be a big booming industry in the next 5 years or so. And I think for the first time I've seen that Bombay has become a world-class city. I mean, you have a metro, you have a sea link, you have a coastal road, you have the NMACC. This construction is going to roll out across the country. While we're doing a very impressive job digitally, I think a physical infrastructure still needs improvement. So a lot of the construction companies should do well. So those are some of my marginal bets.
And I think shipbuilding perhaps is another kind of sort of...
They've been old hats. I've had that for a number of years, and they continue to fine. But, in terms of can they be 5x, 10x? Probably not.
One big theme for you, of course, also has been, and we spoke about this earlier, is in that sense, I mean, state industrial policy, and that's happening around the world. So follow what the state is doing, is spending on, And
We used
that's
to
a
call it
tailwind.
crony capitalism. I think that's exactly what's happening in America. Unfortunately, they're learning the bad things from us rather than the good things, while we are learning good things from them. So I think increasingly the state will, the invisible hand of the government will be replaced by the visible hand of the invisible hand of the markets, replaced by the visible hands of the government. And while we are used to it, of course, that the government directs and the leading source of capex through, say, the public sector stocks, I think it's going to happen in America too. I don't know what Mr. Mathani thinks.
Mr. Mathani, I mean, kind of same question to you. Around the world, of course, it's the state is saying, well, this is what we want to build out. Who are the in that sense, national champions? We need companies in the space to invest, etc. Just your thoughts on this. And the pointed question is, AI is this big theme in the US. Here in India, at least for half a year, there was a lot of hand-wringing and anxiety. And some even said that, well, India is underperformed because there is no real AI companies and everybody wanted to sort of, buy one. But I think slowly that realization is setting in that maybe, as adopters of AI, there are a lot of businesses which will gain here in India as well in terms of productivity gains, the expensive labor costs, etc. Just your thoughts there, briefly.
In general, I think that industrial policy, meaning governments interfering, is a bad idea. That the more they interfere, the worse it is for the country as a whole. So, with rare exceptions. So the government is involved in infrastructure here in a big way. That's a good thing. But something like AI, they probably don't understand. And if you let the private sector do what they need to do, I think the country will be better off as a result. So I don't have broader views than that, but in general, industrial policy, I think, is a no-no. What Trump is doing at tariffs, I think, is a terrible idea.
I think Mr. Damani wholeheartedly concurs.
I mean, I stick my neck out and tell you, Prashant, that I think the decline and fall of the American century is upon us. I mean, this is a country I worshipped, and for 100 years it's been the beacon for free markets. I think Trump has forever changed the political dynamics of America. And even if a new president comes, it won't be easy to change back. So my feeling is that it'll be like Great Britain. It was a power to reckon with, and ultimately they spent themselves out because of world wars, weakened themselves. And today it's a power, but still not one of the great powers of the world. It's really hard for me to say that, but I think America will follow the same trajectory.
I think I could go on, but are we done with time? Yeah, I think we're almost right on time. So, Mr. Raamdeo, Mr. Damani, Mr. Mathani, thank you very much, all of you, for joining us. Thank you for being a wonderful audience, and really appreciate all of you listening in intently. I think we did a round of questions earlier with Raamdeo ji. Do we have time for maybe 1 or 2 questions for Mr. Damani? And maybe we can take 2 or 3 questions. Anyone in the audience? Please, sir. Can we get a mic to him?
You asked Mr. Damani because I have answered enough.
Yes.
Good evening, everyone. And I had my question for Mr. Damani only. So the question is that I'm a wealth manager. I come across a lot of investors, and I get an opportunity to look into their stock portfolios as well. Most of the times, some of the very wealthy investors I've come across, they have a very large list of stocks in their portfolio, and they've created wealth over the last 20, 30 years with as many as even 300, 400 stocks in their portfolio. So is that the right approach, Mr. Damani, and is that how you must have created your wealth today, that you have today, or should it be very concentrated? Because I understand that most of the individuals would not have as much of wherewithal to analyze the stocks so well that they can take concentrated positions.
Yeah, it's a great question, concentration versus diversification. Unlike Raamdeo, who runs a very concentrated portfolio, and he actually, I think it helps to know yourself and know your companies to run that. I run a very diversified portfolio. If Raamdeo tells me an idea, I'll buy some shares. I may not make it a core position, but I'll buy some shares. But my criteria for judging my performance is very simple. Have I doubled my net worth over a 3-year period? And India is giving you that kind of opportunity to double your net worth over 3 years. If you've done that, you're fine. What does it matter how you run your portfolio? There are many ways to skin a cat. So as long as my wealth is moving, doubling every 3 years, I'm on the right track. I'm not very particular about, I would like to be a more concentrated portfolio, but I don't think intellectually I'm equipped to do it because I get very scared of making a big unsurmountable loss, particularly as I'm aging. So I run a diversified
Some
portfolio.
approximate number of scripts could you give us? Should it be 100? Should it be 50? Should it be more than 100?
Sometimes these odd positions I've had. Someone has told me at some meeting like this to buy it, and I bought 10,000 shares. Over time, they multiplied by scripts, bonus, and become some fabulous part of my portfolio. So the top 10 positions in my portfolio will be 50-60%. But then there's a big long tail. I mean, here I might meet 5 friends who will tell me, Sanjay might give me an idea, sometimes he does, and I'll buy 10,000-20,000 shares based on his recommendation, making a lot of money, by the way, on his recommendations. So, I tend to do that. I like to do that. So,
thank you so much.
We can take one more. Anyone? Last one. Yeah. Go on. Yes.
So a lot of people there try to time the market that, when will be the next crash where they will put in the money, and they forget to actually stay invested in the market in all kinds of market. So what do you think about those people? Is it the right approach, or do you think that, all kind of markets have equal opportunity? The question is to Ramesh Damani or any one of you.
I'll ask Sunil to take a first stab at it.
I think timing in general is a terrible idea. So if someone is earning a stream of income so that you can put in money regularly, then dollar cost averaging type approaches work really well. If you just have one pool of money that, say, you inherited today, phase the money in over some time, but then let it ride. It's too hard to time. Better is trying to look to see what you want to put your money in, and then just put it in and leave it there.
About the AI bubble as well, a lot of people are thinking that, it will be the next crash for the US markets and it will be followed up in Indian markets. What do you think would be the significance of it? Would it be a short-term impact on Indian markets, or would it be long-term if it happens? It's a black swan event. Of course, it cannot be predicted, but what do you think about it?
I think it's sort of like the dot-com boom of 25 years ago, where clearly a lot of value is going to be created from the new technologies. There'll be excesses, and then the excesses will correct. There'll probably be some ripple effect in India if it's bad enough in the US. But again, it's all short-term. For anyone who's thinking longer-term, it shouldn't matter at all. Just look for the opportunities when they come.
Okay, I think last word to Mr. Bhattacharya, who's watching closely. And I must tell you before you start, sir, whenever I speak with Sanjay once every 2 days or so, he'll go on this long tirade about, and then, I'll listen for about 15 minutes and then we start to have a conversation. Go on.
I wanted to ask Ramesh, so, I think most people would agree with what you just said, that the US is probably at the end of a long and glorious period where it's been the ultimate world power and has profound influence in many different areas. But were that to pass over time, will there be another country which will assume the mantle of global leadership?
I think it'll be a multipolar world, but I think the US will remain, because of its military, a strategic power. But you know which one I'm talking about, that they will also rise in the East. So I think it'll be a more multipolar world. And I think increasingly, technologies like defense are quite distributed. So whether you use drone or use biological warfare, that is available to many countries in the world. So I have very strong feeling that Trump has actually changed the fabric of this world. He's killing the goose that laid the golden egg. America became strong due to its education, due to its immigration, due to its openness to the world. And he's single-handedly dismantling that. And I think history will record that sometime in the next few years, we'll see the peak of American power.
That was diplomatic, Ramesh. What about the lack of corruption, which has now reached new proportions?
Absolutely. Absolutely agree with you. I mean, this is horrific crony capitalism going on in America, which I would never have believed. I would never have believed that.
And the dismantling of meritocracy.
Absolutely. I mean, they talk nonsense. They keep saying that we're doing meritocracy, no woke, nothing. But they're doing exactly that. you know, they're just taking power because they have the power, whether it's Venezuela, whether it's Greenland, or whether it's Canada, or whether it's Mexico, they're just using their power. I mean, they're telling NATO countries, for example, that you pay up more, otherwise you won't defend you. I mean, that's the equivalent of saying, give me hafta, otherwise I won't defend you. I mean, America never did that. America protected the world, and because it was such a great power, I mean, imagine Tokyo and Germany, Japan and Germany, beaten powers in World War II. They basically resurrected through the Marshall Plan. And today they're such stalwart partners with America for the next 50 years. And, you know, suddenly, you know, the whole world is thinking, let's have our own European alliance, let's have an Asian alliance. So I think America will change for the worse.
Thank you.
And you don't think once in the next 3 years, it's not going back? It's very tough.
It could, but I doubt it. Generally, when the pendulum swings, you know, I mean, there will be some other monster coming in. I mean, yeah, I'm just sorry. I really feel bad saying that because we actually looked at America for almost everything in the world, and I'm just shocked, literally shocked that the U.S. senators, congressmen, you know, they're all speaking the same language, you know. So I would be very happy if America went back to the way it was, but I seriously doubt it.
Thank you very much, all of you. Thanks very much for joining us in this very special panel. Thank you.
Thank you everyone for being a wonderful audience. First of all, thank you to Raamdeo ji for presenting a milestone wealth creation study. My profound thanks to Mr. Mehtani and Damani for sharing the wisdom with our audience at large. And last but not the least, thank you Prashant for wonderfully moderating and curating the discussion. See you all next year. Enjoy the evening. Thank you. May I also request Motilal ji to facilitate our guests.